Hello everyone, welcome to this detailed, elaborate and in-depth video on CRT or candle ranges. Now the main topic of this video is going to be strictly CRT and I'll discuss everything that there is to know about it. And throughout this video we'll discuss topics such as what is CRT, what are its types, why is it used, how is it used, what are the misconceptions around it, what is its main importance, and not only them, but I'll also include some important and concerning topics such as how to use candle ranges, how to integrate it correctly with ICT concepts, how to select candle ranges correctly, and moreover where to find these candle ranges, right? And I'll first of all start off with the fundamentals and I'll lay down the groundwork with the key concept behind candle ranges, like understanding how price behaves within specific ranges and how these ranges form the basis for liquidity. And then I'll build up to the advanced application and I'll teach you how to interpret these ranges in real time to identify high probability trade setups or to generate trading ideas on the higher time frame. Now, one of the key goals of this video is not to just show you what CRT is, but also to show you how it fits into the bigger trading picture, how you can combine it with other key concepts and other key topics like drawn liquidity, high time frame analysis, and narrative building. We're going to discuss how to integrate CRT with these broader concepts to elevate your trading accuracy and precision. I'll also be showing you live chart breakdowns and showing you real market scenarios where CRT is applied in a step-by-step approach so you can see how theory translates into practice. And after going through this whole video, I don't think you'll have any more confusions about CRT left, its importance, its integration, or how to use it, right? And at the end of this video, I'll also make sure to give you a proper framework on how to use CRT and ICT analysis together to make much more informed decision. And I'll also show you the two different ways how you can trade candle ranges. This is going to be the most detailed and comprehensive video you'll ever find regarding CRT. So make sure that you add it to your playlist, make notes along the video, and make sure to like this video so it reaches more people and subscribe to the channel as a sign of appreciation for the work I put in this video, right? And also make sure to share it with your friends. Also remember that all of these concepts and ideas that I'll mention in this video can be used on any asset class, right? Or any instrument or markets, right? Because after all, these concepts are all fractal. It doesn't matter if you are trading forex, crypto, indices, stocks, or commodities, right? Or even synthetics. These things and these concepts work on all markets, right? So don't worry, don't ever worry about that. As long as candles are printing, these concepts would be valid and considered. I get this question all the time, so there is your answer. Also, make sure to not miss the last part of this video, which is the most important part if you want to become a consistently profitable trader with a detailed trading system and plan for every aspect of your trading, whether it's the technical aspects, the risk management aspects, or the psychological aspect. All right, enough of that. Let's get to the video and let's begin. So, moving on to the next slide. Before I start the video, I need to tell you one thing. This video is fully well structured in a chronological manner with sequential topics at the right place, right? Simply meaning that the topics are well organized and they are not random at all, right? So you don't have to worry about that as well. We're going to start off with the introduction to CRT, then we'll explain it in bits, its importance, its uses, benefits, life applications, how to trade it, how to integrate it, and then at the end of the video, we'll have a bit of mindset talk on the psychological aspects of trading, CRT, and how to deal with it. So first of all, let me introduce CRT and candle range theory to you so you accurately understand what does it actually mean and what does it stand for. Now remember, if even if you are using the basics of CRT, or even if you know about the basics of CRT, you must still watch the whole video from start to finish so you don't miss out on any important points regarding candle ranges, right? Because if you want to learn it thoroughly, you wouldn't want to miss any intricacy or any detail of it. So the whole premise and idea of CRT or candle ranges is that certain candles formed at key times which follow specific particular in specific protocols can be treated as ranges. Now, technically, every single candle can be treated as a range, right? But a more refined and objective approach is to only treat specific candle as candle ranges, which follows specific protocols and has specific qualities, right? And this is why the more refined definition for CRT is that it's the idea, a concept, or theory that certain candle can be treated as ranges, then you can position yourself inside those ranges and potentially trade it on the lower time frame respectively, right? Now, two possibilities could occur with those particular candle ranges, right? They can either be truly broken, right? In which case the candle range leads to a key level being formed in the form of an art block or a breaker. I'll show you how it's done in a couple of minutes. And the other possibility in idea, and actually the main and the important one, is that these candle ranges can be falsely broken, in which case you can use it to position yourself and trade it on the lower time frame, right? And by falsely broken, it simply means that price has a turtle soup or a purge or a manipulation of one side of the liquidity of the candle range, and then the drawn liquidity or objective becomes the opposite end of the range. And this is the main idea which we'll use to trade CRT or candle ranges. Now you can see these two bullet points right here. So the first one, these candles can sometimes be falsely broken within a specific framework. Remember, framework is the main part here, right? Broken with a specific framework, within a specific framework, to manipulate liquidity and then causing price to expand in the opposite direction. And other times these candle ranges are truly broken within the same framework, and in those cases they can serve as a support for price to expand further, right? In these cases they can lead to different key levels being formed. This is the main theory behind candle ranges or CRT. Now it sounds simple, but it has got a lot more intricate details into it, which we'll discuss fully in this video. Now let's move on to the next slide and let's discuss the differences between typical ranges and how it differs from conventional ranges and what are the key main factors that leads to those differences. So differences between CRT or conventional ranges. Now the first and the most important and core difference is that CRT offers more objectivity and feasibility in terms of fixed highs and lows, right? We know that candle ranges are inherently candles themselves, right? Therefore, they've got fixed objective highs and lows, unlike typical ranges which have varying highs and lows, and each person can interpret it differently depending upon their perspective, right? Which produces and leads to subjectivity in trading and involves a bunch of variable which acts as a hurdle in your analysis, right? Therefore, a better and more refined alternative is CRT, right? This is the most important difference between conventional or typical ranges and CRT. Now, candle ranges also got opening and closing times, so it also becomes objective and constant in those aspects too, right? You can determine and gauge where it will start and end, and then use that factor accordingly. Whereas with conventional ranges, you don't know when or where it will start or end, so it becomes subjective. The second difference is in their mechanics, right? Now, integrally, both types follow the same dynamics and rules in terms of targets and objectives, but candle ranges are more mechanical because they've got fixed objective targets and a much more clear directional buys or drawn liquidity, whereas typical ranges lack this precision because of their subjective nature. The next and the second most important difference between candle ranges and typical ranges is the alignment aspect or factor, right? Now, alignment basically means aligning and combining different key time frames with each other around a logical framework, right? Alignment of time frame is really important for top-down analysis, right? And you know the main idea and premise of CRT, ICT or CRT analysis is top-down analysis from higher time frame down to lower time frame, and then aligning those time frame collectively to frame entries to determine drawn liquidity to build narrative and so on. And you know that the only time ICT concepts work accurately is when they are logically aligned with each other coherently and not randomly. And we know that candle ranges are inherently candles themselves. That's why they can objectively be aligned within a top-down analysis approach, whereas on the other side, you cannot align typical ranges with each other between different time frames because they've got variable aspects to it. That's why they don't fit into this approach well. The last point, which is almost similar to the first point, which is subjectivity. I already discussed this before, which is that typical ranges are subjective, whereas candle ranges are more objective, mechanical, feasible, and refined because they've got structured and objective highs and lows, and they can be properly aligned within a logical framework. These were the main differences between CRT and conventional ranges. Now, the reason I explain this to you is so that you are aware of both types and so that you have more conviction in your CRT and you never become skeptical about it, right? Because you know that the only other alternative are typical ranges which are not feasible at all. So you would always be content with your analysis and approach. Now, let's move on to the next slide and let's discuss the type of CRT or the type of candle ranges simply. Now, characteristically, there are only two types of CRT. The first and the best type of CRT is the three candle CRT or the three candle range. Now, just as the name suggests, this sort of CRT is made up of three higher time frame candles and consists of only three candles. The framework is that the first candle forms the range, the second candle manipulates the range, and the third candle is the distribution candle. It's just as simple as that. It's made up of three candles. The next type of CRT is the multiple candle CRT or inset CRT. This type of CRT, just as the name suggests, is made up of multiple candles and isn't limited to only three candles. The first candle always acts as the candle range and it's followed by multiple candles for both manipulation and then multiple candles for distribution. Now, this type of CRT can have multiple forms and can present itself in many various types. The first candle is always the ranging candle, and then it can either have a manipulation candle straight away and then multiple candles for the distribution, or it can have a few inside bar candles first inside the CRT before it's purged and then multiple distribution candles, right? It can have various forms, but the idea is that this type of CRT is called the inside CRT or multiple candle CRT. It's different than the three candle CRT. Now, if you ask me, the best CRT is always the three candle CRT because it's the most reliable one, right? Now, it doesn't mean that you should only start using three candle CRT. I don't mean that at all. The premise is that you can have more conviction in your analysis when the CRT is a three candle CRT. Now, before the CRT, you can never know if a CRT would be a three candle CRT or an inside CRT, right? That's completely impossible to know or to be aware of. But there are certain protocols and type factors based on which you can anticipate with a great deal of accuracy whether a CRT could be a three candle CRT or an inside CRT. Now, another type of CRT that I forgot to mention, which can also be classified as an inside CRT, is the two candle CRT. In this sort of CRT, the first candle is a ranging candle, and then the second candle serves both the function. It both purges the liquidity and also reaches the drawn liquidity straight away, right? And you would find this sort of CRT mostly during news times or when we've got a red folder news event. Now, the point of explaining the type of CRT is simple. It's just to make sure that you're aware that a CRT isn't limited only to three candles, but instead it can have other variable forms too. So your perspective on CRT wouldn't be limited. Now the type itself are simple, right, and doesn't have that many intricacies or subtle differences, but being aware of them is important because first to make you conscious and aware, and second to have conviction in your analysis and not fumble, right? You might have already seen the graphics by now. We've got a three candle CRT above here, and below we've got the inside CRT with multiple candles, right? Now let's move on to the next slide and let's discuss the importance of candle ranges and why is it used for, right? This is an important topic that we'll discuss in great detail and elaboration. Importance of CRT or candle ranges. First of all, before explaining the importance of candle ranges, let me give you some context about how proper analysis is done, right? So you know that we learn all of these concepts like turtle soup, the open high low close concept, seasonal tendencies, SMT divergences, market profiles, order flow, power of range, so on, right? The reason we learn all of these is for three things, and all of these three things are done in a top-down approach, starting from the higher time frame down to the lower time frame. It starts off with determining drawn liquidity or directional buys on the higher time frame, like the weekly and daily time frame, right? Now you all are aware of how important drawn liquidity is and how it serves us in our analysis and execution. Second thing that we then do after determining our drawn liquidity is that we build a narrative for price on how it's going to go towards that drawn liquidity and what fashion it's going to go, and moreover how is it, when is it going to go towards that, right? This is what we call building narrative. Then the last thing that we do in our top down analysis is that we frame entries on the lower time frame with an entry model, right? And basically, these are the three main beacons of technical analysis, and you must be fully equipped with enough knowledge about all of them to be able to trade accurately and properly within a sound logical framework. Now, CRT or candle ranges helps us with almost all of these three main aspects of analysis. Not only it helps us determine drawn liquidity on the higher time frame by giving us fixed mechanical and objective targets in the form of 50% of the range in opposing end of the candle range, but also you can use it as a key level tool to build narrative, right? Building narrative is the second most important aspect, right? And CRT helps us with that aspect too. And with the help of CRT, you can build a much more cleaner and focused market narrative, right? And narrative is basically knowing and answering why is price is gonna go towards the non-liquidity, how and in what fashion it's gonna go, and when it's going to go towards the non-liquidity. And answering and knowing these three integrated questions is what we call building narrative, and CRT helps us with that. And then last but not least, the third more important aspect is framing lower time frame entries. And CRT helps us with that too by first of all giving us a logical area where we can look for entries. For example, we start looking for order block entries after CRT lower high spuds. So in that case, you can see that now we have an objective criteria and protocol for when we're going to look for entries or try to frame entries, right? And similarly, we can also frame a case of debt entry and the third or the last candle too with the help of CRT. So you can see that not only CRT helps us with determining our drawn liquidity at the higher time frame, not only with building a much more cleaner and objective narrative, but also it helps us with framing entries too, right? So you can see that CRT helps us with almost every aspect of our analysis, and with the help of CRT, our analysis and executions actually become a lot more refined, objective, and mechanical. And not only that, it also becomes feasible in that aspect, right? These are the importance of CRT, and you should remember them when you are actively using it. Now, moving on to the next slide, let's discuss some misconceptions around CRT here in this slide so that you fully understand the concepts, and any misconception, confusion, or concern that you have about CRT is fully clear. The first and the main misconception around CRT is that people treat it as a standalone pattern, right? Which is one of the biggest mistake people make when using CRT. That is not how I use CRT or how Room you use CRT, right? We use it within a logical framework surrounding ICT concepts and analysis, and only then we are able to have accurate analysis, right? We never treat it as a random pattern. Instead, we wait for specific key levels at key times and look for various protocols and criteria before making any trading decisions or executing any trades around CRT. Now, continuing that first misconception, the solution to that is that CRT or candle ranges requires a logical framework around ICT concepts, and you cannot accurately use it if it doesn't have the right framework around it, right? CRT must be applied within a logical framework and only when it follows specific protocols, right? The first two misconceptions are the important and relevant ones, and now that you are aware of it, you should never be making or repeating the same mistake, and you should consider them in mind when using it in your analysis, and only then you'll be able to see how good it works. Now that the misconceptions are clear, let's move on to the next slide and let's discuss the framework for CRT or candle ranges and to see how does that framework actually works and how you should use it. I'm going to explain this framework with a three candle CRT, but remember that the analogy, core idea, and the theory remains the same for both inside bars or multiple candle CRT as well, right? So don't worry about that. We're going to start off with the first candle, which we all know is the dynamic ranging candle, right? The first candle is the one which establishes the range, right? Not a consolidation, but a range, right? Remember that. Let me explain the difference. A range does not necessarily imply a consolidation. You know why? Because a range can be dynamic. It can be in any side. It could be a huge candle or it could be a small ranging candle, right? It can have various forms, but a consolidation candle specifically means a small ranging candle, right? So don't mix or confuse the two with each other. The first candle establishes the range, but this does not necessarily imply a consolidation, but instead the entire price action of that particular candle is treated as the range framework. The second candle, which is also known as the manipulation candle, what it does is that it manipulates the first candle range by purging one side of the range and forming a turtle soup. Now, this manipulation of liquidity above or below the CRT can occur in two forms, or we can have two scenarios. The first scenario being if the first candle has a turtle soup above the candle range, just like you can see in the graphic, and then it closes inside the range, meaning below the wick of the first candle range, then in that case, the likelihood of a reversal towards the opposing end increases, and the conviction in the analysis would be more strong, meaning we'll have more strong conviction in our analysis, and the odds of that CRT working out increases when that happens. The second scenario is when the second candle closes outside the first candle range, and in that case, the odds of reversal drops and the probability of that CRT working out decreases significantly. But the candle range or CRT still remains intact. The only thing is that you have to be more cautious and risk appropriately in that scenario. These were the two different scenarios you can have with the second candle. Both are valid scenarios, but one is higher probability than the other and has more odds. Now let's talk about the third candle, which is also known as the distribution candle. The third candle is the one which makes the expansion and distribution towards the 50% of the CRT and eventually the opposing end of the CRT. In case of a two candle CRT, the second candle both acts as the manipulation and distribution candle, but that happens really rarely and mostly during red folder news events. This was the whole framework of CRT and what is the purpose of each candle. Now let's move on to the next slide and let's discuss each candle separately. So right here, first of all, we discuss the first candle and see what is the purpose of the first candle and what are the different intricacies surrounding it. Now, as I said before, the first candle is the ranging candles, which forms the range, but it does not necessarily imply that it is going to be a small consolidation candle, right? Or whatever. It doesn't stand for that at all. Yes, it can be in the form of a small consolidation candle sometimes, but also more often than not, you'd see that the best CRT are also in the form of these big bulky expansion candles. First candle being the candle that forms the range means that it acts as the main framework for the range around which we'll be working and generating ideas on the higher time frame. Down below you can see the different forms of CRT. We've got these consolidation candles, we've also got these medium sized candle, and then we've got these huge expansion bulky candles, right? All of them can be technically treated as candle ranges or CRT as long as they are following the protocols that are needed for a candle to be considered a valid CRT. Now the point of me explaining this to you is to show you that the type, the color, the race, or even the nationality of the candle does not matter, right? There's no discrimination or racism in that. What matters is the framework around the candle and whether the candle is following the protocols and has the criteria behind it or not. And as long as we have all of those confluences backing up the candle, you can treat it as a valid candle range, right? In the same manner, the size of the candle also does not matter, right? It's not necessary that only a huge candle can work better as a CRT. You can even use a small consolidation candle as long as there's a sound logical framework behind it, right? Those were the details of the first candle. Now, moving on to the next slide, here we will discuss the second candle of the CRT, which we all know as the manipulation candle. What the second candle does is it manipulates or purges liquidity of the first candle range and forms a turtle soup. And as I told you earlier, we can have two scenarios with the manipulation candle. The first scenario is that if the second candle closes inside the range, the likelihood of a reversal towards the opposing end of the CRT increases by a huge margin, and your analysis would be considered strong. That is the first scenario. In that scenario, the odds would be in your favor. The second scenario is if the second candle closes outside the range, and then in that case, the probability of a reversal drops, while the range still remains intact, and you can trade it or generate trading idea around it. But the thing is that you must be cautious around it and risk appropriately in that scenario, and risk lower than what you usually do, right? That would be a less favorable scenario, and the odds would be lower. Next up we've got is the third candle, which is the distribution or expansion candle. The third candle handles the distribution, right? The first target for the distribution is the 50% of the CRT, and the second target is the opposing end of the CRT, right? It's just as simple as that. The more important candles are the first one and the second one, right? The third candle is pretty simple and doesn't require that much caution and consideration as the first two candles. The first two candles set up the foundation and base for the distribution in the third candle. Now moving on to the next slide. Right here we'll discuss one of the most important and least talked about part of CRT or candle ranges, which is trading candle ranges, right? Now most people are really uninformed about this topic, so let me fully elaborate this topic to you in the most refined approach possible. Now there are multiple ways to trade candle ranges, but in this part I will discuss and elaborate the two most refined and objective methods or approach which I personally use myself, and you might have seen that in my breakdowns that I upload weekly in my coaching program CPI. One of that approach deals with trading the second candle, and the other one deals inherently with trading the third candle, right? These two are the same approaches that I personally trade candle ranges with. Now let's discuss each one of them separately. So first of all, we'll discuss how to deal and trade with the second candle. Now the optimal way to trade the second candle is through an order block entry, right? Or what some people would call a model one entry. This is the most refined and objective way to trade the second candle, right? This is a confirmation entry that occurs or forms after the second candle punches the CRT and then displaces in the opposite direction. This sort of entry has a confirmatory aspect to it. That's why it's more refined and better than a turtle soup entry. Once an order block is formed after the purge, you would take an entry there and then price would distribute to the opposing end of the CRT. The second way to trade a CRT is through the third candle. The best way to trade the third candle is by using a case of death or KOD entry. This is the last turtle soup entry before price reaches the opposing end of the range or the drawn liquidity. This is how you trade CRT in two different forms or methods. Now, personally, I only trade the second candle with an order block entry, right? That is the most objective and mechanical approach, in my opinion, because that one has got fixed objective protocols and criteria for entry, stop loss, and target. So it is a lot more simpler in that aspect. Whereas Turtle Soup, on the other hand, has a lot more intricacies or details into it, making it much more harder and complicated to trade. Now let's discuss how to trade the second candle even more. So this type of CRT is what we call the order block entry or the model one entry, right? So the whole framework is the following. Down here you can see that this is a CRT, right? Now, how is this a CRT is a whole topic in itself, which we'll discuss later in this video. But let's assume this particular candle follows all the protocols that are needed to become a valid CRT or a valid candle range. And now we want to trade it on the lower time frame. So on the left, we've got this candle range on the higher time frame, but towards the left, this price section that we see is on the lower time frame, right? Now to know which particular time frames are these, we'll use time frame alignments, but that's also another topic that we'll discuss later in the video. So how this framework works is that first of all, we would wait for the CRT to be purged at a key time. And once that happens, you would go down to the lower time frame based on your time frame alignment. You'll analyze and look for the candle that purged the CRT, right? You would find that exact particular candle that purged the CRT. You would mark out that particular candle, And in this case right here, you can see that the CRT was purged with this particular candle. So what I have done is marked out this candle, right? And then the next step is that you'll wait for price to engulf this candle. And what I mean by that is that you will wait for price to close below that candle, price to go below and close below that candle. And once it closes perfectly, the candle that you would have marked out will turn into a valid order block, right? And that's how order blocks are usually formed. Now, if you haven't watched my mini order block chapter from CPI that I've uploaded for free on my YouTube channel, then you should watch that one first as well, and you'll know exactly what I'm talking about. The candle that purges the CRT, you would wait for that particular candle to be engulfed in the form of price closing below it or above it in terms of a bullish CRT. And once price engulfs and closes below that particular candle, an order block would be generated. And then the way you would take an entry there is by putting a limit order at the low of the order block and your stop loss above the order block high. And you would first of all target the 50% of the CRT and then eventually the opposing end of the CRT, right? And the 50% of the CRT would be used as your first place for trading your stop loss or taking partials, and then you leave the rest of the order for the second target, which is the opposing end of the CRT, right? This is how an order block or model 1 entry is formed, right? And this is exactly how you would trade it on the lower time frame. This is exactly how I trade the second candle, right? Now let me show you an example of it. Here is an example of a Model 1 order block entry. On the right, you can see the higher time frame CRT, and what you can see is that the CRT was purged right here on the lower time frame with this particular candle right here. This is the candle that purged the CRT, so that means this is a significant candle for us now, because our objective is now to wait for this candle to be engulfed in the form of price closing below it, and once price closes below it, we put a limit order at the low of this order block with our stop loss above the order block high, and then we target the opposing of the range, right? We'd also make sure to take partials at the 50% of the range, or we would trail our stop loss once price reaches there. You can do either of the two. You can either just trail your stop loss or take partials, right? That's up to you to decide, and you're going to decide that by gathering as much data as you possibly can and then comparing the performance of both with each other and choosing the better alternative, right? And you must also consider your psychological aspects in it too, because some traders are more suitable for a shoot and forget approach in which they take an entry and just close the charts until the target is reached, right? I'm also that type of trader, because personally I take an entry and then close my charts until either my stop loss or target is reached, right? I set alarms at key places and then I forget, right? Because what I've realized is that if I look at my charts or my PNL, right? If I look at them, what happens that it consistently messes up with my performance. And then what I do is I try to manage my trade and manage my stop loss and target, which messes up with the dynamics of my trade, and my edge essentially becomes ineffective in that case. And you know that in trading, the most important thing is to follow your system and let the edge play itself with probabilities. So for me, that was the solution to my execution problem that I struggled with in my initial stages of my trading journey. And I've solved that by approaching that particular trade management style, and it's working best for me now. Now, for some of you, it might be different. You might have different psychological tendencies, and maybe you're good with managing trades and taking partials inside trades, and that's up to you to decide. But make sure that you don't make that decision based on just a few trades or a few experiences, right? And make sure that you don't ever let recency bias cloud your judgment about anything. The way to make changes to your trading model or system is by gathering months and years of data, right? At least 2 years worth of data before you can even make a minor change to the way how you approach things. Now you have to do both self-evaluations and psychological evaluations before making changes to your system, because it's not just about the performance of the model itself, but it's more about how you can execute that model or whether you're psychologically capable of that or not. And remember that there's nothing wrong with admitting that you can't handle looking at your PNL and charts, and you're more suitable for a set and forget approach, so that it does not messes up with your psyche, because if it does, it will ruin your whole performance. If you keep forcing yourself to a single trade management style and approach, even though you're not psychologically or mentally suitable for it, then the only thing that would happen is that you'd be stuck in a cycle of losses, never realizing what is the core issue that you're suffering with, because apparently you want to be top G and you think that you can do everything, right? No, you can't do everything. You can't. Your mindset is wired in a certain way and you're only capable of handling certain situations, right? Yes, of course, when it comes to other aspects of life, you can do everything and anything you want as long as you stick to it, right? Never giving up and approaching is smart. But remember that right here, right now, we are talking about trading. And trading the market works differently than your ordinary life, right? That's why 95% of the people are losing, because if it was just about the technical aspects of trading and it was just about technical analysis or learning the holy grail or enigma or CRT, then everyone would be profitable, right? Because in learning this stuff is honestly not that hard. But the main issue is that most people never realize that you have to approach trading differently as compared to how you approach other aspects and other fields of life, right? And other parts of life you can grind hard, and by grinding you have to work hard, not stop for hours. But that isn't true for trading. And trading, grindings mean stopping and being patient and sitting on your hand most of the time without participating or doing anything stupid in between your trades, right? 90% of your time I stay patient and wait for my entry setups, and then the rest is me executing those trades, right? But you people do the opposite because you want to be the next top G and you want to fuck with the markets, right? Like a whore. And you know how that eventually ends up. The market ends up fucking you the other way around, because the market does not give a shit about you. At the end of the day, it's you versus you. It's not you versus the market. It's not you versus Romeo or you versus Sham or you versus ICT. It's all about you versus you. You're the only one standing between yourself and profits. And the sooner you realize this, the better, right? Trading is a solo game and no one is there to help you. No one can save you from the curse of the markets. And it's up to you to change that curse into a blessing. And you can only do that by doing self evaluation of your psychology, sticking to a system that suits your mental capabilities the best, and sticking to a bulletproof risk management and staying critical and logical at all times without letting your emotions and sentiments cloud your judgment or your decision making process. Right? If you have a bulletproof mindset, then the strategy or your trading approach does not make that big of a difference. If you have a strong and developed a critical psychological approach and mindset, then you can even become profitable even with indicators or classic support and resistance. But if you don't have the correct mindset and psychology, then it doesn't matter. It doesn't matter if you're using CRT or Enigma, you'll still lose no matter what, right? You can have a 90% win rate, but you'll still lose. This is how important the psychology or the psychological side of trading is, right? And you get to learn about these things with time and experience, right? And now I can talk to you about it all day long, but most of you probably would not get it, right? And you would just laugh it off thinking that this guy just waffling. But it's just a matter of a few years and a few experiences before you come back to this video and listen to this rant again, and you'll say to yourself that shit, Sham was actually right, right? It's me versus me and you versus you. So remember that. Moving on, right here you can see another model 1 order block entry right here. You can see it's a bearish entry. You can see right here that this is the exact lower time frame candle that purged the CRT, and then price came down below, engulfed that particular candle and closed below it, and then it became an order block. And now our job would be to put a limit order at the order block, stop loss above the order block, and target the opposing end of the range. That is how you trade a CRT with the second candle. Now moving on, here we got another order block entry. You can see we've got a bearish CRT. Uh, uh, you can see that price purged the CRT with this particular candle, right? And our job would be to wait for this candle to be engulfed and for price to close below it. And once price closes below it, we'll then take an entry. And you can see price closes below it here, and then it tests it, right? And then starts distributing and expanding towards the opposing end of the CRT. Now moving on to the next slide. Here we got an order block entry again. This time we've got a bullish entry. Again, you can see that this particular candle engulfed a purchase ERT, And then what happened is that price came above and engulfed that particular candle that purged the CRT and closed above it. And now we're going to put our limit order at the order block high with the stop loss below the order block, and we'll target the opposing end of the CRT. And you can see that the entry worked out. Now enough of that, let's move on to the next slide and let's discuss how to trade the third candle. So as we had discussed earlier, the proper way to trade the third candle is through a case of death entry or a KOD entry, which is basically the last turtle soup before price reaches the higher time frame drawn liquidity or the opposing end of the CRT. Now, if you are aware of the sequence of moves that price uh, follows inside a CRT or within a CRT, then you would know that it first of all starts with a turtle soup, which manipulates the first candle range and purges liquidity, and then after that we engulf the candle that purges the liquidity, and an order block is generated there. After that we test the order block is a lower time frame key level, and then we expand higher from there. And after that we have an order a breaker entry and OTA. And then last but not least, before prices reaches the drawn liquidity, what price does is generate even more liquidity by forming a high right here, right? Right below the drawn liquidity, and then it retraces and traps buyer and sellers on both ends, and then at the end price has a turtle soup or counter purge and takes out liquidity and buyers before it starts expanding higher towards the drawn liquidity. And your entry in this case would be to take the entry either at the turtle soup with your stop loss at a key level of the lower time frame below an intermediate or significant swing low. In this case we've got this protected low, so stop loss would be set there. And the second approach to trade a case of death entry is through a lower time frame order block entry there as well, by waiting for an order block to be formed there after the last turtle soup, and then trade the order block with an even more refined approach and straight away targeting the drawn liquidity, right? Now I never take turtle soup entry myself, right? Really rarely I ever take them, and most of the time my entries are order block entries that forms after major purges and turtle soups at key times around key levels, right? These were the two ways how we could trade CRT. The first one dealt with trading the second candle, and the second entry dealt with trading the third candle, and both were objective and mechanical in their approach. Now remember the thing about order block entries are that you're gonna miss them sometimes, and honestly you have to realize and accept that that's an aspect and part of the game, right? You can never catch all opportunities. Sometimes you're gonna miss trades, and that's completely fine, right? And you should never let that cloud your judgment, because let's say you missed an order block entry, and then based off of that you decided that you're gonna change your entry model because your sentiments were hurt by that. And if you ever do that and make changes and adjustment based on recency bias and based on a few small experiences, then you're only doing yourself harm, right? And nothing more than that. The thing in trading is that you will miss trades, you will lose trades, and you will even have losing streaks. And you have to accept all of them with an open heart and accept that losses and missed opportunities are inevitable in trading. And the best you could do about them is that to trust your system and your process, and most importantly, trust your edge and let the probabilities play out. And I can assure you that you will end each month and each quarter with profits, and I guarantee you that. But remember that only stays true if you have an edge and if you've got a plan and a complete system that tells you what to do in every situation, that has fixed entry models in place, planes, and set rules for all sorts of higher time frame and lower time frame analysis, right? Determining drawn liquidity, building narrative, everything is included in it, right? And only then that principle will stay hold and stay true. But if you're just a pattern trader randomly taking trades without any fixed objective plan, then you're good for nothing. If your trading is exciting and every day you get to experience something new, then that means you're doing everything wrong. Real and actual profitable trading is monotonous, vague, and extremely dull, right? It's boring and repetitive because you've got an objective mechanical system, and all that you're doing is that you're following your system day in, day out without anything new because you trust the process and you have full trust in your system. That is how actual trading works, right? It has to be extremely monotonous, boring, and repetitive, and not exciting at all. And you need to remember that you must take care of both sides of trading, right? Both the technical sides of trading and the psychological aspects of it. Now let's move on to the next slide. So, till now in this video, I explained CRT or candle ranges to you separately in the most detailed way possible, right? Those were all the intricacies and details surrounding CRT that you need to be aware of and know of. But it doesn't end there, right? We still have yet to discuss the most important aspect of CRT, which is its integration with ICT concepts, which will further helps us in selecting CRT correctly, right? Which is like the main concept you guys are here for. Selecting CRT properly, and then we'll also learn how to find CRT, and then most importantly how to properly integrate it with ICT concepts correctly, right? So that it becomes more feasible and tradable, and the most refined and objective approach possible. So this next half of this chapter will be strictly about integration of ICT concepts with candle ranges and how to properly approach it in the best way possible, right? We'll be discussing a lot of things, so make sure that your pen and paper are ready because we'll be making a lot of notes, and it's going to change your whole perspective about trading and your analysis. So let's move on to the next slide. First of all, we'll start with the introduction to the topic of candle ranges plus ICT, and what does it mean and how you're going to approach it and what are the key main points to consider. First of all, as I've said multiple times before, candle ranges aren't enough on their own, right? Candle ranges alone are not enough on their own. That is something that I know and admit because the correct way to approach approach CRT is with ICT concepts, and when they both are integrated properly, only then you'll be able to see how good they work. And you know that treating CRT as alone as a standalone concept would only lead to pattern trading, and you all know that pattern trading is a poison, right? It slowly fades away your life in torture, so avoid that at all cost. In the same manner, even ICT concepts without CRT are pretty much insignificant, right? In the sense that it lacks any objective or mechanical framework that you can turn into an edge and work with, right? And on the other hand, you can see that CRT offers and provides a proper framework needed for a precise drawn liquidity, narrative building, and framing entries, which is why we've got ICT and CRT, right? This whole idea of ICT plus CRT is the missing piece of the puzzle, right? ICT concepts are good in finding key levels, determining what market profiles or order flow are we in, but the problem for most of you arises when you try to determine a refined objective drawn liquidity or you try to build a narrative, right? Right? And it doesn't end there. Most of you also struggle with an entry framework for where you can take accurate and precise entries with constant fixed protocols. But when you combine CRT and ICT, all of those problems are solved completely, and then you have a complete system that solves every one of that problem in every aspect is carefully considered with a proper approach. The first and the most important ICT concept that comes into play when integrating CRT with ICT is time frame alignment. Time frame alignment is the first and the main concept that you need to be aware of and fully understand in order to properly approach candle ranges and ICT together. Without time frame alignment and without the correct time frame alignment, you wouldn't be able to align different time frames with each other. You wouldn't know which time frames to look for CRT for your trading or which time frames to take entries or determine drawn liquidity or build narrative, right? You would be completely clueless about the relationship between different time frames with each other and what purpose that does each time frame serves in our analysis. It's really important and crucial. It's actually one of the foundational and fundamental stone to understand time frame element completely for you to be trading accurately and to be able to analyze logically with a sound logical framework, right? This element involves aligning different time frames with each other based on the trading style that you've got, right? And based on the different styles of trading like scalping, intraday trading, swing trading, position trading, and so on, they've all got different time frames and they are aligned differently with each other, and each one has a different purpose and function, right? And and also depending upon what type of trader you are, you have to be aware of each one of them to be able to properly produce trading ideas and then to frame entries around it, right? It's the fundamental aspect of top down analysis, and without it everything that you know of is fully redundant and useless, right? Now let's move on and let's discuss an example of how time frame alignment is properly approached. So right here we'll discuss the time frame element for intraday trading, and we'll see how different time frames are aligned with each other for this particular style of trading. So for each time frame element, we'll use three main time frames, right? And then one or two sub time frames. Now forget about sub time frames for now, but let's discuss the three main time frames that you'd use. First of all, we've got the higher time frame, right? Now, depending upon your trading style, this higher time frame could be the monthly chart, the weekly time frame, or even the 15-minute. But as we are discussing alignment for intraday trading, so in this case, we've got two higher time frames, the daily and the 4-hour time frame. Now, for me personally, I also use the weekly time frame as a sub time frame along with it to determine my drawn liquidity. But the basic idea is that the daily and the 4-hour would be your main higher time frame for intraday trading, right? Daily time frame would be used for determining drawn liquidity and directional buys, and then 4-hour would be used for finding and identifying key levels, also to find CRT and to build narrative. Another time frame would be the intermediate time frame, and in case of intraday trading, it's the 1 hour time frame, and it would be used for market profiling and order flow. And then last but not least, we've got the 15-minute, which would be used for framing precise entries, which is our lower time frame for this particular style of trading. Now, as I said earlier, each trading style will require their own unique time frame element to maximize their effectiveness of CRT plus ICT integration together. Moving on, the next integration of CRT and ICT comes in the form of market profiling and order flow, right? Now, these two are the main important concepts which we'll use to define structure and determine drawn liquidity or directional buys. And then your objective would be to trade it in the direction of the particular order flow, and you'll choose the correct market profile to properly trade it, right? Candle ranges are more precise and effective when combined with ICT market profiles and correct order flow. And what this does is this ensures that you consistently select the right directional buys and align with the correct market profile. Market profiles in order flow not only are used to determine drawn liquidity or to determine engaged structure or to build narrative, but also they can be used as elements of filters, meaning they'll help you filter out different market conditions that will help you weed out the low probability conditions and scenarios, and you will avoid them and only participate and engage with the quality and the higher probability conditions, right? This combination increases the accuracy and reliability of choosing the correct candle ranges or CRT. And you know that when these concepts are combined with each other or integrated correctly, they'll help you in selecting the correct CRT more accurately, right? I will discuss this later in the video. Now, if you're not aware of my coaching program CPI, then let me tell you about it. In it, I've made tens of chapters on each one of these topics and concepts, right, that I've discussed so far, whether it's candle ranges, market profiles, order flows, or key levels. I've made hour-long chapters on each one of them separately, and then I've made separate chapters about their integration as well. So if you want to watch and learn more about these concepts, you can join CPI. Along with that, I also upload 2 to 3 weekly trade breakdowns in CPI about the trades that I take throughout the week, and I explain my thought process thoroughly in a top-down fashion, but, from higher time frame down to the lower time frame, to show you how these concepts are properly and correctly aligned with each other in a logical fashion, and how they are used in the real markets to generate trading ideas and to frame entries, right? And along with that, I also show you my weekly execution on a day-to-day basis so that you are fully aware of everything. You can join CPI. The details are in the description. Now, enough of that. Let's get back to the video, right? I'll also make sure to briefly explain each one of these concepts here in this particular chapter, in this particular video, so that you know how they are used with candle ranges. Now, first of all, let me discuss market profiles briefly here. Now, what you need to know about market profiling is that it is used to determine which sort of profile the market is moving in, and how we can use each profile to make informed decisions about determining drawn liquidity or building narrative, right? Now, there are different types of market profile. There are 5 different types of market profiles. We've got the consolidation or ranging profile, manipulation profile, expansion profile, retracement profile, and then last but not least, we've got the reversal profile, right? Now, each one of these profile has specific characteristics and then potential outcomes and combinations based on different varying factors and confluences, right? All of them also react differently to key levels and CRT. Now, understanding the correct market profile is essential for applying candle ranges or CRT effectively, and that will also help you accurately determine your drawn liquidity or directional bias, and that will also help you even more in building a much more cleaner and sharper narrative. Now, if I started explaining the different characteristics of each one of these profiles and their combinations and possible outcomes, then it would literally take hours for me to just explain that. But that is what market profiles are essentially used for, and that's what you need to remember. Now, the detailed hour long chapters on each one of these concepts and topics are on my coaching program CPI, but let me briefly discuss it here with you. The video is already too long, so let me briefly explain. First one we've got right here is a ranging profile. In this sort of profile, the market accumulates liquidity and forms a range or consolidation. Now, ranging profiles are formed at certain times of the day, which are called time-based ranging profile, right? They've got various characteristics such as they generate and accumulate liquidity, they are formed at key times of the day, and they can have different orientations. The only possible outcome after a ranging profile is a manipulation profile or an expansion profile depending upon the framework of key levels and dealing ranges and much more. And then we've got these expansion, retracement, and reversal profile here, each one having their own qualities and intricacies. Now, this is just a single type of these profiles. We've got other combinations possibilities as well, with a lot more intricacies and details resonating with real market conditions. But the basic idea is shown here, and it can help you understand what type of profile are we in, and then depending upon that, you can determine your drawn liquidity or built narrative. Moving on, the next concept that we've got in the integration of ICT plus CRT is order flow plus candle ranges. Now, this is the second most important concept that you need to understand and be aware of in order to use candle ranges most effectively. Now, as I discuss these other concepts, you need to be aware of this fact and realize that these are all integrated with each other in a proper logical fashion, right? It's not like we'd only use CRT and order flow with each other or a market profile and CRT with each other, right? It's not like that. It doesn't work like that. We discussed market profiles and now we're discussing order flow. So that means you're now going to integrate and combine order flow, market profiles, and candle ranges all with each other, and then continue the process and a step-by-step approach even more as we combine more and more of these concepts like the open high low close concept, SMT divergences, dealing ranges, key levels, and so on, right? That's what you need to remember. Now let's discuss order flow. So order flow or advanced market structure involves identifying the underlying flow of orders in the directional bias of the market and price action, right? It plays a crucial role in determining drawn liquidity and ensuring that you stay on the right side of the markets at all times. And this way you'll be able to trade with the trend or order flow of the market, not against it, right? And that way the odds will always be in your favor. There are primarily two types of order flow. We've got bullish order flow and bearish order flow. A bearish order flow is when price is consistently rejecting above highs and breaking below lows. This type of order flow or advanced structure is what we call bearish order flow, and in this case your objective would be to find only bearish candle ranges and look for trades and the direction of the higher time frame down liquidity, which is going to be bearish. Next up we've got is bullish order flow, and in this kind of order flow price is consistently rejecting below lows and breaking above highs. Price is making higher highs and higher lows, and your drawn liquidity and directional bias is higher. And your objective would be to make bullish narratives and look for bullish candle ranges in the direction of the drawn liquidity and not against it. Now the best candle ranges or CRT are typically formed in the rejection of highs and lows. Now moving on, let's discuss some graphical representation of order flow here. On the right, you can see that we've got a bearish order flow. Price is making lower lows and lower highs, but that's not the main thing. The main important thing is that price is rejecting above highs in the form of forming these manipulation purges, and it's breaking below past lows or old lows, and the whole shift of momentum is towards the downside. The main two aspects of a bullish order flow are rejection above highs and breaking below lows, right? That's what you need to remember, and that's how you're going to be able to accurately determine drawn liquidity. If price is consistently rejecting more highs and breaking below lows, then that means the order flow is bearish. On the left, we've got a bullish order flow, and in bullish order flow, we've got price rejecting below lows and breaking above highs. And typically, you would find the best candle ranges right at these rejections of highs and lows, right? In this bullish order flow, the best candle ranges or CRT would be formed in the green areas right here below the rejection of lows, and then you'll be able to accurately position yourself there. Order flow has got a lot more intricacies to it, like knowing about protected lows and highs, intermediate highs and lows, short-term highs and lows, and so on. But it would literally take another hour to explain them. So let's cut it short here and let's move on to the next slide and let's discuss the next most important aspect of CRT and ICT integration. Next up we've got here is CRT plus key levels. Now key levels or PDRAs are zones in price action which acts as a catalyst for price to expand or reverse from, and with higher time frame key levels being the most significant ones. These key levels are often tested or mitigated during manipulation and expansion profiles, and the best candle ranges are also formed at these key levels or around these key levels. Key levels are one of the most important concepts when it comes to integrating candle ranges with ICT concept, right? We so far learned about order flow and market profiles, and each one of those concepts has their own relation and integration with key levels. For example, different market profiles have different reaction to these key levels, and knowing and being aware of every one of them is essential to understanding the dynamics of the markets and how key levels act differently depending upon the market profile, and that way you'd be able to exploit it more effectively. Similarly, even with order flow, we know that the most integral part of determining order flow is gauging and assessing the rejection of highs and lows, right? If highs are being rejected, then we are a bearish order flow, but if lows are being constantly and consistently rejected, then we are in a bullish order flow. Now, with every one of these rejection below highs or lows, you'll always find a key level there to support the idea and to act as a catalyst from where price could react off and expand, right? Similarly, let's say we have a ranging profile, and now we have to anticipate and predict what the next profile is going to be, and to determine that we'd have to use key levels. If the ranging profile has not tested a key level, right, and there is a key level above it, then the first thing price would do, and the first profile that price would make would would be a manipulation profile to purge the liquidity above the ranging profile and to test the higher time frame key level, and then that manipulation profile will end there, and then the next profile will be an expansion profile lower. But let's say if the ranging profile has already tested a key level, then the next immediate profile would be an expansion profile straight away. That's how you integrate key levels with order flow and market profile. And let's say you did not know about key levels, then you wouldn't know which profile to expect or anticipate. But now that you know of key levels and its integration with order flow and market profiles, you would be a lot more informed in your decision making process. Now, the most effective key levels are the following. We've got order blocks, fair value gaps, or FVGs, higher time frame breaker blocks, rejection blocks, and last but not least, highs and lows and important swing points. Now, each one of these key levels have specific characteristics, and they are formed in a mechanical manner with their own origins, right? Each one of them is formed differently and has their own functions at different scenarios and different integration of market profiles in order flow. And it's important for you to understand each one of those intricacies and details in order for you to use them effectively in your analysis and while framing or generating trading ideas. Right here you can see this graphical representation. Let me give you the framework first of all. So let's say we've determined a drawn liquidity with market profiles and order flow, and we've determined that the directional bias is higher, which means that our drawn liquidity is higher, and our objective is to look for bullish candle ranges so that we could position ourselves in there. Now right here you can see this black line. This black line right here represents a key level or key levels on the higher time frame, right? Now it could be any higher time frame key level. It could be an order block, an FEG, breaker block, whatever, right? The type of key level doesn't matter, but just remember that this black line represents a higher time frame key level. Now what you can see right here is just above this key level, we formed this ranging profile right here, right? Price formed a small consolidation above this key level, and generated liquidity for price. That means that first of all, we were in a ranging profile. The second thing that we now have to determine and identify and anticipate is that what is the next profile that we can have after this ranging profile. And based on the factors that we have a key level below us and the drawn liquidity is higher, meaning the order flow is bullish. So first of all, we have to reject below this consolidation and this ranging profile lower to test the key level and to reject below the low. And then once we test that key level, after that we're gonna have an expansion profile higher, right? And right here you can see that that's exactly what happened. Price had a manipulation profile with that it purged liquidity and tested the key level. And after that manipulation profile, the next profile that we had was an expansion profile higher. And we know that because according to the fundamentals of market profiles and its integration with key levels, the only possible outcome after a manipulation profile is an expansion profile in the opposite direction. Also, if you remember what I said earlier, then you would know that I said that the best CRT or candle ranges are found at manipulation profile or expansion profile at around key levels below the rejection of lows. And right here, if you see this framework, first of all, you can see that we rejected below this low, so we've got one factor. We are also in a manipulation profile, so that means another factor. And then we've also got a key level, and you can see that we have a high probability CRT there that price found, right? And more often than not, or almost all of the time, you would see that at around the higher time frame key levels inside manipulation profile, you will find CRT there, and then you can position yourself in that CRT once it's properly purged. And this example, you can see that this CRT is purged. So let's say this is all happening on the higher time frame. So what you would do is that you would look at your time frame alignment, and let's say this is the 4 hour time frame. Then you would go down to the 15-minute time frame, and as soon as that CRT is purged on the lower time frame, you would then look for order block entry and trade the second candle, which you will know is that first of all you're gonna wait for the candle that purged the CRT to be engulfed, and then you would put a limit order there with stop loss below your order block, and you would target the opposing end of the CRT, right? That's how you would trade it, and that's how you would generate a trading idea. That's how you integrate market profiles, order flow, key levels, and CRT with each other, right? Now you can see that we are using a proper logical framework instead of choosing and selecting random candles, right? And that's exactly how you select a CRT. We will discuss this topic in detail even more in the last part of the chapter, right? You can see that we are using specific criteria for each aspect, and we are being critical and objective in our approach. And I'm confident that this is the first time you're ever hearing about candle ranges or CRT talked about in this manner, right? No one else actually knows about this stuff or even aware or they are even aware of it, right? Everyone uses it like a pattern and posts hindsight bullshit all the time. And that's why you never learn from them and end up losing all the time, right? Because they teach you in patterns when the reality you have to learn about all of this integration before you could accurately and effectively use CRT or find CRT, or then be able to trade it. Now, another huge point here would be that this manipulation profile and this whole reaction occurs at a key time, and the candle range is also found at a key time, which would increase the odds in your favor even more. But that's another topic that we'll discuss in a minute. Right here, we've got this another example. You can see the black line again, which represents a higher time frame key level. You can see right here in this example, this candle formed right here just above this key level, and then the next two candles were inside bar candles inside the first candle, right? And you can see that as the first candle generated liquidity above this key level, and let's say this happened at a key time, and that's why you would have selected this candle as a valid CRT or candle range. So after these inside bar candles formed, our first expectation would have been for price to purge the CRT and test the key level along with it, right? And your objective in this case would have been to look for order block entries on the lower time frame inside the second candle after the purge happened. Now, if you are confused as to which time frame to choose for entries, then that's where time frame alignment comes in, right? For example, let's say the CRT is formed on the 4 hour, meaning this price action that we are seeing is from the 4 hour time frame. Then in that case, you would look for order block entries on the 15-minute time frame inside the second candle. Your second entry would have been right here inside the third candle with a kiss of death entry, and you would have had more than enough conviction for that entry because you can see the second candle closed inside the candle range, so the odds would be more in your favor. Now moving on to the next slide. Right here in this slide, we'll discuss the most important part of this chapter, which is integrating candle ranges with time, right? And then making much more informed decisions based on it. We all know that both ICT concepts and CRT are redundant and useless without the integration of time, because it's actually time aspect of the charts which makes all of these concepts meaningful and gives us an edge. And without the time aspect of the charts, all of them become mere patterns. But when you combine the time factor with it, only then it becomes meaningful in significance, in the sense that it gives us a huge edge over the markets, and the odds increases in our favor by a huge margin. And it's actually the time factor and the time aspects of the charts which validates most of these concepts. For example, if a particular reaction occurred at a key time, only then it will be considered a valid or worthy of taking, right? Otherwise, you would consider it invalid and avoid trading it at all, right? Time is the most critical aspect in both CRT and ICT analysis. And every concept that we discussed so far and the setup that we mentioned must align with key times in order for them to be considered valid or worth trading. Now, time in the context of charts includes the following aspects and concepts, right? Basically, you would use the following concept to accurately align yourself with time and get it all together and integrate it properly. First of all, we've got quarterly shifts, seasonal tendencies, week of the month, day of the week, and then last but not least, kill zones and key times, which is the time of the day. These are all the concepts that you would use in a top-down approach from higher time frame down to lower time frame to accurately align the price concept with the time factor of the charts, and then you would make sure that they are aligned correctly before taking any entry or making any trading decisions or generating any trading idea. Now, each one of these concepts itself needs a separate chapter to discuss their details and intricacies, and they are fully discussed in CPI both separately and their integration with each other. But in short, these are the concepts that you would use to be able to crack the time aspect of the charts and to combine time and price with each other, right? These are all the essential concepts which will help you filter high probability trades and ensure that CRT and ICT concepts are applied effectively within the right temporal logical framework. For example, quarterly shifts and seasonal tendencies are used together to determine key times and months of the year where major moves could occur, and then based off of that factor and based off of those concepts, you can then effectively position yourself in those key months of the year, and your directional bias and drawn liquidity would be on point at that time. Similarly, you would use the open high low close concept, the power of three, and the AMD concept to divide the monthly ranges to weeks and filter out the best weeks where the major expansions or reversals could occur and where it's optimal for you to participate. And then even within week, we've got multiple days, and each day has its own characteristic depending upon key level, CRT, and dealing ranges. And you're going to use weekly profiles and power of three to determine which days are you going to participate and which one to avoid. And then last but not least, even within the day, you have key times in the form of kill zones, key macros, and silver bullets where CRT are formed, CRT are purged, key levels are tested, and expansion occurs, right? And this is what the importance of time is. Now, key levels are formed at all times, right? They're also tested at all times, but you're not going to participate in all of them, but instead your objective as a CRT and ICT trader would be to participate only in the high probability key levels reactions that occurs at key times, such as during kill zones or key macros within a day. For example, if a key level is tested or a CRT is purged during the Asian session, then obviously you wouldn't participate or find trades in there, right? Because that's not a key time. You're only going to participate if that reaction occurs within a kill zone or at a key time alongside the correct logical framework. And from this, you can see that it's pretty clear and proven that time is inherently more important than price, and that is essentially why time is such an important part of our analysis. If you analyze and reverse engineer most of my trades, then you'd find a reoccurring theme among them. You'll see that most of my entries are repeatedly taken only at specific times of the day, And you'll never catch me taking trades outside those times, because for me that would be deemed as blasphemous, right? I religiously follow my system, and I always make sure that price concepts and time concepts are properly aligned and integrate with each other within the correct logical framework. Moving on to the next slide, here we'll discuss the time aspect of the charts in a bit of detail. Now, the most important two aspects of CRT are that CRT are formed at key times, and then they are also purged at key times, right? Now, this is an important topic that we'll discuss later, but this is something that you must be aware of and consider while you are dealing with CRT. Now, right here, you can see these small rectangles, right? These small rectangles represent key times of the day or key times of the week, right? However, you want to interpret it, right? Because the thing is that all of the ranges, like the yearly, monthly, weekly, or even the daily ranges, all of them have key times within them. And those key times, we know that they only make up a small part of the whole range, and then the rest is low probability times, which we would want to avoid at all cost, right? So let's say we are looking at intraday price action right here. So these rectangles would represent either kill zones or key macros or silver bullets within the day. But let's say if this was the yearly range, and then in that case, these rectangles would represent seasonal tendencies where price is expanding higher during the yearly range, right? So it depends upon the type of time frame that you're looking at and the type of range that you are looking at, right? So in this case, let's say we're looking at the intraday price action, right? And let's say this green area represents 3 a.m. Eastern time, Eastern Standard Time, which is a good macro for price to purge CRT and test key levels and form order block entries. The second one, which is the blue rectangle, that one represents the 8 a.m. or 9 a.m. Eastern Standard Time, which is also a key macro time within the New York open kill zone, and that is also considered a good time or a key time for these sort of reactions. And then the next one is the 11 a.m., which is also a silver bullet and a key macro where CRTs are purged, key levels are tested, and these sort of reaction occurs, right? And remember, this is literally as close as it gets to the real dynamics of the markets, right? You would find these blueprints and these sign in signals all over the markets at these key times. If you backtest these exact same thought process, you would find that these principles and rules stay true most of the time, and that's exactly how price moves at key times around key levels. What you can see right here is that price came down lower during the 3 a.m. macro within the London Opal Kin zone, and during it, it purged the CRT, and along with it, it tested a discount bullish key level somewhere right here. Now, as we know that this purge happened in a key time, that's why our objective would be to look for order block entries. But let's say the purge had happened outside this key time, then in that case, we would never trade it, but instead we would wait for another CRT to be formed at a key time and then wait for it to be purged correctly at a key time, right? Now, the important thing is that a CRT could be a valid one, but you also have to wait for it to be purged at a key time, right? In a correct time. If it's purged outside a key time, then you wouldn't consider it a valid one, right? Because both the formation of the CRT and both the time of the purge both are important, right? It's not only about the time of the formation of the CRT, but also the time of the manipulation or the purge of the CRT, right? So you can see the purge occurred at a key time, and after that we had a CSD, or a change in the state of delivery, because price closed above the leg or the candle that purged the CRT. When such swings or candles which purge the CRT are engulfed in the form of price closing above it, an order block is formed there, right? And those are the two fundamental aspects of an order block: filling liquidity or purging liquidity, and then price closing above it or below it, right? And after that is done, price will test that order block, find support there, and expand from there towards the drawn liquidity, which for us would be first of all the 50% of the range, and then eventually the opposing end of the range. And then after that, you can see price retraced lower during the blue rectangle, right, which is also a key time. And at that time of the day, price formed the OTE or the OTE leg, right, the optimal trade entry leg, and expanded higher even more. And you can see the reaction occurred at a key time. That's why it worked out perfectly. Now, if you've diligently studied my post and content before, then you would know that that sequence of move are what we call the sequence or TSQ, right? And what happens in that sequence is that price starts off with a turtle soup, right? And purges. either side of the CRT range, and then an order block entry is formed there, and then price test that order block, and after that we have a breaker entry, and then an OTE, and then we end the sequence and reach the drawn liquidity with also a last turtle soup known as the KOD or the kiss of death entry, right? Or simply the second leg accumulation or a second leg distribution in case of a bearish drawn liquidity. You can also see this case of death entry or this KOD happened at a key time 2, which is the 11 a.m. macro, which is represented by this red rectangle, right? And all of the moves, the purge, the order block entry, the OTE, and last but not least the KOD, all of that happened at key times, and that's why they worked out perfectly, right? Now go over your charts and find CRT there, and then study the moves within that CRT on their respective lower time frame based on time frame element, and you'll always find this sequence of moves within every CRT or within every candle range, and you'd be shocked by how precise and dead accurate this is. Moving on, here we've got another example of time in price. Here you can see we've got this swing high right here, and let's suppose we are looking at the 15-minute price action right here. So what you can see is just below this high, we formed a ranging profile right here, you can see, and based on time, the most probable time for this ranging profile or consolidation is going to be the Asian session range. So what happened is that during Asian session range, we formed this ranging profile and generated liquidity just below this high, right? So we know after a ranging profile, the only possible outcome if a key level isn't tested is a manipulation profile at a key time to test the higher time frame key level and to form a CRT there. And you know that the manipulation profile would only occur at a key time. And right here you can see we've got this green rectangle, and this green rectangle represent the key time from 2 a.m. to 5 a.m. Eastern time, which is basically the London Opalkin zone, which is a key time for manipulation profile to occur and key level to be tested, right? And that is also when price forms the high of the day or the low of the day. You can see the manipulation profile occurred correctly at a key time during the London Opalkin zone, and with that we tested the key level at a key time. And you can see we rejected above a high, and more often than not you'd always see a CRT form there. And you can see that this is the price action on the 15-minute. So if you are a scalper, then for that based on time frame element, if your CRT is on the 15-minute time frame, then you would trade it on the lower time frame such as the 1 minute time frame, right? Now right here you can see just above this rejection above this high, that is where you could find a CRT or candle range to be formed. And after the manipulation profile ends, we would expect and anticipate price to expand lower towards the down liquidity lower. And this is how you align time and price correctly with each other. Now moving on, right here we'll discuss an actual example of a CRT combined with key time. What you can see is that we've got an example of a 3 candle CRT right here. What happened is that the first candle formed the candle range, and then the second candle passed the CRT at a key time, right? Now this could be any key time depending upon the time frame that you are looking at. If you're looking at the monthly time frame, then this green area would represent a key time based on seasonal tendencies or quarterly shifts. If you are looking at the intraday charts, then this rectangle would represent kill zones within the daily range and so on. So let's assume this is a 4-hour CRT and we are looking at the 15-minute price action on the right. So then based on the framework, this green rectangle would represent a kill zone such as the London Open, New Year Open, or a New Year Open kill zone, or a refined key macro or silver bullet within those kill zones. What you can see is price came above and purged the CRT in the second higher time frame CRT candle and purged the liquidity above the candle range, and it did it during a key time, so it would be considered a valid purge based on that, right? Now after this happens, our objective is to look for an order block entry on the second candle, right? And to trade the second higher time frame candle, you know order block entry is used, and the way how that work is we mark out the candle that purged the CRT, and then we wait for that candle to be purged in the form of price closing above or below it. And once that happens, and once that candle is engulfed, right, and price closes below it, an order block is formed there, and then your job would be to enter on the low of that order block, stop loss above the order block, and target the opposing end of the range or the candle range low, right? And you can see that is exactly what happened here as well, and you could have easily traded this CRT right here with this order block entry. Now, forget about all of the other types of entry like FEGs or inverse FEGs or bracket entries, right? You just have to only catch this type of entry and this is it, right? This is the most objective and mechanical entry you would ever find, right? It's simple, but at the same time, it's the most effective entry in terms of both technical aspects and psychological aspects, right? It has fixed protocols for entry, stop loss, and targets, right? Whereas if you take an entry on an FEG or an inverse FEG, then you would face a lot of problems, right? Because you wouldn't know which fair value gap to choose and where to put your stop loss because there are too many variables and factors involved in that process. And you know that the more variables that are involved, that leads to more subjectivity and more complication in your trading, right? And you should be seeking simplicity and effectiveness because we know that simplicity scales and complexity fails. Now moving on to the next slide, here we'll discuss the two main aspects regarding CRT or candle ranges and its integration with time. Those two important aspects are timing of the formation of CRT or simply the idea that CRT are formed at key times and the timing of the purge of the CRT or the idea that CRT are also purged at key times, right? Those two are the main important aspects when it comes to choosing CRT correctly or aligning yourself correctly in CRT. Those two aspects makes up most of your thought process and decision making process, right? For example, a CRT could have all of the influences, but if it's not formed at a key time, that way it won't work at all. But at the same time, a CRT can only have a maximum of only one or two confluences behind it. But if it's formed in budget key times, it will work like a charm, right? Your main priority should be the timing of the CRT and its manipulation or purge time, right? Now, this doesn't mean that you're gonna forget about the price framework or concepts completely, but instead you should be more inclined towards time while using every single confluence and combining time and price with each other, right? After all, it's time and price and not just time or just price, right? You have to integrate both of them. And anyone who just focuses on time alone is just as dumb as the one that focuses on price alone, right? The only correct way is to have a balanced approach and focus on both time and price and consider each aspect before generating a trade idea or executing a trade. Right here in this slide, let me tell you about CPI, which is my mentorship and coaching program. In this mentorship, you're getting access to over 50 plus chapters, and every one of those chapters will cover every aspect of your trading. And they'll not be just separate chapters on important concepts and theories, but also there will be chapters on how to integrate these concepts with each other in a step by step approach in the most refined and objective way possible. Plus, there will be more than 100 live trade breakdowns where I will explain the real time application of these concepts that you are learning. Because, after all, this isn't just about the theory, but it rather is about understanding how to integrate everything into a logical framework and then to be able to execute it properly in the live markets, right? You'll be taught how to determine the drawn liquidity in a step by step approach. You'll be taught how to build narrative both on the higher time frame and lower time frame with a step by step approach. And then you'll also be taught how to correctly build time based narrative and then frame entries on the lower time frame. We will dive deep into risk management and I'll show you how to apply the right risk models for different market conditions and different account types. You will learn about the psychology of trading, how to manage emotions, how to stay disciplined under pressure, right? And also, along with that, we will also cover journaling so you can track and improve your performance over time, which will improve your long term profitability, right? We will also discuss how to backtest to refine your strategy. And of course, I will also show you my live execution and show you how you can execute the most effective way possible so that you put everything into action. This coaching program will cover every single aspect of your trading that you can think of. And after going through this program, there won't be any confusions or doubts left. You'll have the confidence and the clarity needed to approach the market with a solid and a structured plan and a structured system. You'll also have a private group chat with me, and I'll also be sharing my personal CRT and ICT system and model with you. And it doesn't matter if you are a beginner, an intermediate, or an advanced student, this is literally for everyone, right? It has a complete curriculum from basics all the way to upper advanced where you're capable of executing accurately in the most objective way possible, right? And you can see the other details yourself. The fee is a one-time fee of $360 and the payment method is crypto only. You'll find the crypto addresses in the description and in the pinned comment of this post. What you have to do is send the one-time payment fee to one of those addresses and then take a screenshot of it and send your receipt to my DM and Telegram, and you'll be given access to CPI, the mentorship, and the group chat. And right here, you can see the details of CPI and what's included in it. It'll contain 7 levels of detailed content about every single aspect of trading, analysis, or execution, right? You can see the 4 levels right here in the content included in it. There are also 3 more advanced level worth of content along with it that is secret for now. It's a complete curriculum and you won't ever need anything else apart from it. Now, moving on, let's discuss the timing of the formation of the CRT first, and let's go over its details and the whole thought process behind how it works and why is it the way it is. Now, the idea is the highest probability CRT are formed at specific days of the week and specific times of the day. And that is true because time is more important than price, right? And the expansion, distributions, and even manipulations occur at specific times, right? And the major moves always are predetermined and occur at predetermined key times, right? And using this filter, it will help you weed out all of the lower probability CRT from your analysis and trading, and you will only end up trading the ones that are high quality and high probability in nature inherently. And you're going to make sure that the CRT is aligned with the high time frame order flow and is formed at the correct market profile, which means you're going to combine all the other protocols and then you will look for such CRT at key times to form and to be purged at key times. For example, right here you can see that this candle range is formed on Monday. Mondays are usually ranging days where price set up the initial hook for the rest of the week, and Monday basically determines the weekly range expansion and weekly profile for the rest of the week. So Monday is usually a good day for CRT to be formed. Similarly, other key times for CRT to be formed are 9 p.m. for the 4 hour time frame, and the reason for that being a key time for CRT to be formed is the fact that that is the Asian session range and usually price forms a ranging profile, so you can use the Asian session range as a CRT and look for manipulation profile around it in the second candle, right, during the London Opal Kid zone, and then look for entries once the high of the day or the low of the day is formed. Similarly, you can also use the 1 a.m. 4 hour candle as a CRT too, and then look for purges. Then look for purge to happen during London lunch at 6 a.m. and it would be a key time for price to reverse, considering that the London Open and during the 1 a.m. candle price has tested a higher time frame key level and the drawn liquidity has integrally changed. At the end of the day, it all depends upon the framework that you are working with, and then time acts as the last piece to validate all of that framework and narrative that you built, and you end up generating a valid and a high probability trading idea. Moving on, another important aspect of CRT or candle ranges is the timing of the purges of the CRT. So the idea is that not only we wait for the CRT to be formed at specific in key times, but also the purge or the turtle soup or the manipulation of that CRT also has to happen at specific times. After all, the second candle where the manipulation of the candle occurs is basically a turtle soup or a purge where a higher time frame key level is tested, and we know that all of that reaction must happen at key time to be considered valid and considered. And this is what we also call time alignment. Time alignment is basically aligning the timing of the formation of CRT and the timing of the purchase of CRT with each other surrounding a logical framework, right? Now, some key times for the purchase are the following. The 1 a.m. hour or candle is a key time for manipulation profile to occur or turtle soup to be formed or CRT to be purged, right? And particularly during the 1:30 a.m. Eastern Standard Time. Similarly, we've also got the 3 a.m. key macro time within the London Opal Ken zone, where the high of the day or the low of the day is usually formed, and that's also when CRTs are usually purged. And then we've got the 6 a.m. Eastern Standard Time inside London lunch, where London lunch reversal occur, and if the framework is correct and strong, it can lead to a really good reversal trading ideas. We've then got the 8 a.m. and 9 a.m., particularly the 8:30 and the 9:30 a.m. Eastern Standard Time, which are basically the CME open and the New York Stock Exchange opening bell times, and that's where volatility is injected to the market and major manipulation and expansion occur and CRT are purged. Then we've also got the 11 a.m. Key time, uh, during which CRTs are purged on the lower time frame, right? And those are some of the key times for intraday charge during which CRT are purged. Now, one thing you must be aware of is that it's not necessary that you're gonna find this every day, right, in every single time. But it's just that you need to be more cautious around these times for CRT to be purged. And if a purge happen in these times, only then you'll consider it valid and have strong conviction in your trading idea. Now go over your charts, mark out 4 hour CRT with a logical framework around it, and then see which times were those CRT purge, and you would see that more often than not, it's actually these times that I mentioned above, right, during which CRTs are mostly purged. These were the two main aspects of CRT: timing of the formation of the CRT and timing of the purge of the CRT. Now, these timing of these purges that you see right here stays true for all of the asset classes in markets, right? Whether you're trading forex, indices, cryptos, or commodities like gold, these timings are all true, right? These timings are true for all of them. So don't worry about that, right? It works on everything. Moving on, here we will discuss another intricacies of candle ranges, which is a lower time frame CRT within a higher time frame CRT, right? These type of CRT are also high probability CRT, and if you can manage to find it correctly within the correct framework, you can have a really good and accurate drawn liquidity and directional buys on the higher time frame. So the framework is simple. Identify a CRT on the higher time frame based on the protocols that I gave you, right? Meaning it should be formed at a rejection of highs and lows. It must be formed at key times, and then it should be purged at key times, right? It must have a key level around it. And once you've identified a candle range with all of those protocols, if you go down lower to a lower time frame below it, you will see a lower time frame CRT within the higher time frame CRT more often than not, right? When the higher time frame CRT is purged, right? And the lower time frame CRT is usually formed at the second candle of the higher time frame CRT. And this is a way to refine your higher time frame drawn liquidity even more and to position yourself more accurately. Now let's move on to the next slide and let's boil everything down to the four aspects or the four main beacons of technical analysis. So, till now, you see that we talked about almost all of the things. We discussed CRT and candle ranges completely, and I explained all of its intricacies to you. Then I taught you about its integration with ICT concepts such as market profiles, order flow, time frame alignment, time and key levels. Right now, these aren't the only concepts that are needed. We've also got other important concepts like advanced intraday and weekly profiles, the open high low close concept. We've got power of three, seasonal tendencies, quarterly shifts, daily ranges, and so on, which are also needed to be properly learned before you are able to use ICT and CRT concepts together accurately, right? And not only you have to learn about those concepts separately, but also you need to have the proper knowledge about their integration with each other and how they can be used together in a logical framework. Now, the point is that all of that analysis and integration is done for three purposes, which are to determine directional buys or drawn liquidity on the higher time frame accurately, to build sharp and cleaner narrative, for example, how price is going to go, which market profile or intraday profile is going to form, and what sort of order flow it is going to use to reach the higher time frame drawn liquidity. This is what we call narrative. And then last but not least, to frame lower time frame entries, which is the last but the most important aspect. Now, each one of these aspects requires separate knowledge about different concepts and their integration. For example, for determining drawn liquidity and directional bias, you need to be fully aware and be equipped with enough knowledge about CRT, market profiling, order flow, higher time frame key levels, daily ranges, and so on. And only then you will be able to know how to properly generate a logical framework that you can further use to build narrative with concepts like CRT, open high low close concept, weekly and intraday profiles, SMT divergences, and so on. And then last but not least, you must also have knowledge about different entry models and which entry model suits you the best and what is your go-to entry setup or entry technique, right? It can either be in the form of trading the second candle of the CRT in the form of an order block entry, or it can either be in the form of trading the third candle with the kiss update or KOD turtle soup entry. And then, of course, the most important part, which is that you're going to be using time to validate these concepts and their reactions. And for that, you're going to use concepts like seasonal tendencies, quarterly shift, weekly AMD, kill zones, and silver bullets, and so on, right? These are the four fundamental beacons of ICT and CRT analysis. And when you have enough knowledge and experience about each one of these aspects and you know how to properly deal with them, only then you would have finally cracked every single one of your problem, and only then you'll be able to know how to execute and analyze properly, right? And then the only objective for you is to manage your risk appropriately, be disciplined at all times, and have the right psychology and thinking patterns, and just be a logical and critical individual, and then you'd be a consistently profitable trader. Now moving on. Combine all of these elements with time and integrate them accurately to validate your setup and your analysis, and ensure that the alignment with key timing is properly done, and you will end up having the highest margin of accuracy and precision possible, right? Those were the four elements of technical analysis, particularly when it comes to ICT and CRT analysis together and its integration. And each one of them has to be properly learned and appropriately approached correctly before you're able to use them correctly. Moving on to the next slide, here we'll discuss one of the most frequently asked questions about CRT or candle ranges, which is that where to find CRT, right? Now, surrounding CRT, it's the most asked question and no one really knows how to answer it. That's why in this part of this chapter, I will clear all of the doubts once and for all so that you have no confusions or concern left, right? I'll show you where you can find CRT and how to find CRT, or simply how to select CRT correctly. So down below we've got these three bullet points right here, right, which basically sums up the whole thought process for looking for CRT and finding and selecting CRT correctly. First of all, I'll just narrate each one of them together, and then we'll go over each point separately in detail. So the first place where you can look for CRT or candle ranges is at range highs and lows, right? This is the most important place or area where you will find high probability CRT at range highs and lows. When range highs and lows are purged on a higher time frame, the candle that usually purges the range high or low is taken as a CRT and selected if the timing is correct and everything is aligned with each other and we've tested a key level. Similarly, next up we've got is rejection of highs and lows. Now, just like I told you throughout the video, candle ranges are often found in bullish or bearish structure below rejection of lows or above rejection of highs respectively. Now, the candle that usually rejects the high or low it is treated as and taken as the candle range and then used appropriately considering it's following the protocols, and we've got a higher time frame key level aligned with it. Next up we've got is higher time frame key levels, right? Now this is pretty obvious by now because I've been talking about it for hours, and the reason for that is simple, that it's really important. You must always make sure to match higher time frame key levels and look for CRT around key levels, specifically higher time frame key levels. Next point we've got is candle ranges are found at major turtle soup or purges, right? And last but not least, we've got the most important point, which is that the best TRT are usually formed during manipulation profile, right? Or manipulation phase when liquidity is being purged. That is where usually the tops and bottoms are formed. And you'll see that almost all of the time there is a CRT present there during the manipulation profile. And if you can back it up with the right framework and the right protocols, then you can accurately gauge tops and bottoms with CRT. Now that you are aware of these points and this knowledge, you'll be better equipped with knowledge about selecting and finding CRT correctly. And also make sure not to forget that along with all of these protocols or points, you must always consider the time aspect at all times and make sure that the reactions and purges and formation occurs at key times in macros. Now go over your charts and examine these key zones and price, these range highs and range lows, rejection of highs and lows, and you'll always find the best CRT to be formed there. Right here you can see the graphical representation of the first point that we had, which was that CRT are formed and can be found at range highs and lows. What you can see right here is that we got this range with clearly defined highs and lows. Now according to the first point, the best and high probability CRT are formed at range highs and lows once they are purged. And usually the candle that purged the range high or low is taken as the CRT, and the top or bottom is formed there and price reverses from there after the CRT is purged. You can see that we first purged the low with this candle right here, and price then purged that candle range and formed the bottom there and then reversed from there. In that case, that would have been your CRT, that exact candle which purged the range low, right? You would have chosen this candle as a CRT here, and your drawn liquidity would have been above, and you would have accurately determined your drawn liquidity, and you would have framed a correct narrative there. And after that you can see we purged the range high with this particular candle, and then we took that exact candle as a CRT, purged it, and then price reversed from there after purging it. Now the way how you would have validated these purchases in this CRT is by looking to see whether there is a higher time frame key level around it or not, above or below the CRT or not. And then the second thing you would have done is you would have looked to see if these reactions had happened at a key time. And if they had happened at a key time and there were high time frame key levels around it, then you would have validated these purchases and considered it valid. You can see the green rectangle right here, which represents a key time, and you can see price spiked the range high during that key time, which meant that the reaction occurred at a key time and the CRT was also formed at a key time. Then it was purged at a key time and price tested a higher time frame key level, and after that price reversed from there and the CRT worked out perfectly, right? And let's say this is the weekly chart, then in that case you can see that if you had chosen this candle range of the CRT correctly, then you would have been right about the drawn liquidity for almost 3 weeks, and your drawn liquidity and narrative would have been correct throughout that time period and time window. Moving on. Here is another example of CRT at range highs and lows, but in this case we've got a different framework. In the first one, we choose the candles that purge the range as CRT, but in this sort of framework, I'll show you that we can also have this scenario in which price forms the first ranging candle to generate liquidity just above or below the extreme of the ranges, and then the second candle is the one which manipulates liquidity both above or below the range high and low as well as the candle range respectively, and then the rest of the candle distributes towards the opposing end of the range, right? We can have this type of scenario as well, and you need to be aware of it. And these are the best places where you will find candle ranges in CRT: above range highs and below range lows, right? Now most of you choose and select random candles and then treat it as a CRT, and then it doesn't work for you, and then you tell me that CRT doesn't work. But now here I've shown you the correct way to choose and select CRT, so hopefully that problem is solved for you and you don't have any confusions left. Now moving on, again right here we've got another graphical representation. You can see that after purging the range low right here, price what happened is that price then took that particular candle as a CRT as a candle range and then purged it and then expanded to the upside. Now, if you are a good observer, then and if you remember the first part of the chapter, then you would remember me saying that candle ranges are not only falsely broken in this form, but they can also be truly broken. And in that case, price used those candle as support to react off of it, and then that candle ranges inherently turns into an order block. And here is the example of it. First, the candle range right here was purged fastly, and price completed the framework by expanding towards the opposing end of the range, but right here it was truly broken to the upside, and now in this case it turned into an order block, and now price could potentially use it as a key level in the form of an order block and expand from there. And you can see price came down below, find support there, uh, and then expanded from there. And from this you can see that candle ranges can not only can be used to accurately determine or frame down liquidity, but also you can use it to assess and gauge where key levels are born and key levels are formed, right? This is how most key levels are formed, through the help of CRT. And after the expansion toward the end of the range, you can see we formed a range high there, and then we purged it at a key time, and after that we repeated the same framework all over again, right? And that's how we would have chosen the correct CRT or candle ranges, right, at range highs and lows. And these are the blueprints and signs that you will find all over the charts at each swing points and range highs and lows. Right now, go over your charts, backtest this start and backtest this framework, and you will see that CRT, high probability CRT, are always formed at around range highs and lows. Now moving on, let's explain the next bullet point, which is that candle ranges are formed at rejection of highs and lows. After going through this chapter, most of you would probably already know what rejections are, where does these rejections occur, and why do they occur, and what each type of rejection represent, right? If we have a rejection below low, then it's a bullish order flow. But if price is consistently rejecting above highs, like in this example right here, then the market is in a bearish order flow. Now, in case of both order flow, you would find and see that the best and the most important CRT are formed at these rejections of highs and lows, right? The most important and essential thing is that rejections would always occur at key times, and along with these rejections, price would always make sure to test a key level or a PDRA, and all of that leads to price forming a CRT there, which initiates the top and bottom being formed, right? And that's where you're gonna find these CRT. Here's a graphical representation. You can see on the left we've got a higher time frame, and on the left we've got the lower time frame price action. What you can essentially see is that we are in a bullish order flow because we are rejecting below lows and breaking above highs. On the higher time frame, we've got this higher time frame key level in the form of this order block, and on the lower time frame, you can see that we're going to position ourselves in this trend by waiting for price to reject below low, right? And we would avoid all of this price action and only position ourselves once price purges below or rejects below this low and test the higher time frame key level, and there, more often than not, you will always find a CRT present there, and then that CRT would be also formed at key time, and then my objective would be to wait for that CRT to be purged so that I can then position myself on the lower time frame, right? That's how you look for CRT, and that's where CRT are usually formed. Moving on, next up we've got is key levels, right? Now the best CRT are formed at around key levels at key times, right? We've already discussed this before, and let me explain it briefly here. A key level acts as catalyst for price to react off of and expand towards the higher time frame drawn liquidity. And based on that, it makes perfect sense that candle ranges would inherently be formed here because we know that CRT gives origins to major tops and bottoms, and there you can position yourself accurately and more precisely. You will find the best CRT at around key levels. On the left, you can see that we've got this key level in the form of this higher time frame order block. What you can also see is that price is rejected below this low right here, and our drawn liquidity is higher. So in this scenario, price rejected below this low, tested a key level, and all of this reaction occurred at a key time. So based on all these factors, you would have selected this candle as a CRT, and it would be a valid CRT, and it would have worked out perfectly for you. And if you had gone down to the lower time frame after the CRT was purged, you could have then also positioned yourself in the second candle with an order block entry and targeted the opposing end of the candle, right? That's how you would have had a proper framework to work with and to frame an entry with, right? Moving on, and again, right here, you can see that based on the protocols that I gave you, the best candle ranges or CRT are formed at rejections of lows and inside manipulation profiles. And right here, you can see that we have this manipulation profile below these equal lows, and our drawn liquidity is higher. And along with that, we also tested a higher time frame key level, but it doesn't end there. Another huge important factor is that all of this happened at a key time. So based on all of these confluences and factors, you would have chosen and selected this candle right here, which purged below the and which purged and rejected below the lows as your CRT, and this would have been the most logical and critical CRT you would have ever seen, right? And it would have worked out perfectly for you. And then again, you would have waited for this CRT to be purged on the lower time frame, and then traded with an order block entry on the lower time frame based on its time frame diamond. Now in all of these examples, you can see that I'm using a proper logic and a detailed thorough process to choose and select CRT and candle ranges, right? I'm not choosing random candles, but instead, all of them follows a specific thought process, and each one of them is backed by a logical process with a sound logic behind it, right? There are no randomness to it. Everything is perfectly clear, and the whole interaction is done in a proper fashion and manner, right? And this is probably the first time you've ever seen this. Most people that talk about CRT are in no position to mention it or even teach it, right? And I fully guarantee you that, and I can bet my house on it, that they're here taking notes off of this video, and now you would see that they'll start talking about these things as well because I've now taught it to you. Just make sure and remember that you learn CRT from the main sources, and that being me and Romeo, right? And not follow some random clueless individual online on Twitter pretending to be your guru and mentor. And don't be so gullible and vulnerable, right? Have some critical thinking and choose your mentor wisely, right? Think wisely. Now, moving on. Again, right here, another important protocol for where you can find CRT is that you can find CRT during manipulation profile or at reversal profile. We've got this framework right here. You can see we've got these key levels, and how the price action is started is that we first of all started off with a ranging profile just below this key level to generate liquidity, and then we had a manipulation profile at a key time, and with that we also tested higher time frame key level. And if you zoom into this price section right here inside this manipulation profile, you will always find a CRT formed there in this sort of price action, right? And that is where you will find the best CRT to be formed at key levels after testing high time frame key levels and during manipulation profile. Also, you can look for the same framework when price tests a higher time frame key level or reaches return liquidity during the expansion profile, and then the next profile is mostly going to be a reversal profile, and you will always find a CRT there as well, right? Which initiates the bottom there, and price then starts expanding from there and reverses to the upside. Now, the way how you would position yourself there in the reversal profile in both this manipulation profile is through a CRT or candle range, right? It's the most accurate and objective way to position yourself, and that way your drawn liquidity would always be on point. Now, explaining all of that brings us to our next topic, which is selecting CRT correctly. Now, so far till now, we discussed the topic of where to find CRT, and now the last and the most important part is to now figure out where and how to select CRT correctly and properly, and we'll discuss that in the next slides. So let's move on to the next slide and let's discuss how to select CRT correctly and properly. Now, before we get into this topic, I just want to let you know that I've been teaching all of these stuff to you in this particular video. I discussed every single aspect of CRT and ICT with you. I first started off with an introduction, its explanation, what it stands for, what does it mean, and then I talked to you about its types, the different framework for each candle, and then we discussed how to trade candle ranges the correct way, right? We discussed each topic in the most thorough and objective way possible. After that, I moved on to teach you about the correct integration of ICT and CRT with each other, and I explained topics like market profiles, order flow, key levels, and time, which are integral parts of CRT and ICT, right? And without all of them, these concepts are redundant, right? And they'll never work for you if you don't have the correct knowledge about it. And remember that it's not just about being aware of every single concept separately, but the most important part is to how to combine and integrate all of these concepts with each other in a proper manner so that you are able to combine your higher time frame analysis and lower time frame analysis with each other in a proper top-down fashion. And then you have a clear system or model which tells you everything about what you have to do and what not to, right? Now, if I started explaining each and every single concept that is important, like seasonal tendencies, quarterly shifts, EBITDA data ranges, weekly and intraday profiles, dealing ranges, and many more that are important to learn, then it would literally take weeks for me to explain their integration, right? And that would also not be enough because you also need to be shown the proper live execution of it and breakdown so that you know how you can generate trading ideas in the live markets and then how you can frame entries with it, right? Because that's the most important part. Learning all of this is sweet, but the real growth and development in learning occurs when you see laughter breakdowns of these concepts, and then you'll understand how you can use it yourself in live markets, right? And you'll see definite changes in your perspective and your whole approach. Now, to solve that problem, I have my own CPI coaching and mentorship program, where it has got more than 50 chapters for explaining each and every one of these concepts separately and detailed 1 hour long videos. And then I have separate chapters for explaining and teaching you about the integration of these concepts, right? And then each week I also share my live trade breakdowns with you as well as my execution so that you can see the live application of it, right? If you want to learn more about it, then you must watch the last part of this video. You can skip to it if you want. That will give you all the details regarding CPI and what's included in it. Now let's get back to the topic and let's discuss how to select CRT properly. Now when selecting CRT, you can have two approaches, right? Each approach and method has its own pros and cons and a definite technique to trading it or using it, right? The first one being the conformational CRT and the second one being the advanced CRT. Now let's move on to the next slide and let's discuss each one in detail. First one we'll explain here is conformational CRT. Now, first thing first, if you are in the beginning or intermediate stages of your trading journey, then it would be a lot better for you if you just predominantly focus on conformational CRT, right? It will be a lot better for you. Now let me explain why you should stick to this sort of conformational CRT and what are the key aspects of it. Now, just as the name suggests, this sort of CRT or this method of selecting CRT requires confirmation before you could trade it. That is why it's a lot more simpler version of CRT, because before you can trade it, you are waiting for a confirmation that decreases your probability of being wrong on the trade or losing it, right? In this sort of CRT, you'll only be trading the third candle and you'll forget about dealing with the second or first candle, right? You'll have nothing to do with those two candles. Your objective would be to wait for the first candle to finish and form the ranging candle. And after that, if you can't really predict or anticipate whether this particular CRT candle can be used as a range, then in that case, you will wait for a confirmation in the form of the second candle manipulating the CRT candle or purging it, and then you'll wait for the second candle to close, right? Now, even in this scenario, you can have two cases. And the first one, which is a high probability scenario, in which the second candle purges the CRT and then it closes inside of that particular candle range. And in that case, your confirmation is strong and the probability of that CRT playing out is also strong. And you can have more conviction in your analysis and you can then trade that CRT with the third candle, right? The second scenario is when price purge the first candle, but then the second candle closes outside the CRT, which is a low probability scenario. Now it's a low probability scenario, but it doesn't mean that the CRT has become redundant or invalid, right? It does not necessarily indicate that at all. It's just that you have to be more cautious in that scenario and risk appropriately based on that narrative. Now, the significance of this CRT is that you're not trading the second candle, but instead you're looking for a confirmation in the form of the second candle closing, right? And then based off of that, you are measuring and assessing whether this CRT is a good one or not, right? And then you'd also have time to see whether this particular CRT follows all my protocols or not. For example, you're going to look and see whether we've tested a key level or not, whether this CRT is formed at range highs or lows or not, and whether all of this reaction is done at a key time, right? And so on. And you're going to look at all of these factors that I showed you and taught you earlier, and then based off of them, you're going to confirm and validate your CRT accurately and objectively. With this sort of CRT, your drawn liquidity can be extremely objective and refined, because your goal will be to trade the third candle. And in that case, you can use the open high low close concept and look to buy below the opening price of the third candle and then target the opposing end of the range, and it will work out best for you. For example, let's say in this graphic that we see, the price action is on the weekly time frame, and you can see that this is the example of a confirmational CRT, because the second candle has closed, and let's say we checked and analyzed its protocols, and let's say it's following all of them. So now based off of all of those factors, our objective would be to generate a trade idea based off of it. And here the narrative would be pretty clear. We would wait for the third candle to open here, and we would look to buy below the opening price on the lower time frame, and our drawn liquidity would be the 50% of the range and then eventually the opposing end of the CRT. If you focus only on this sort of CRT or this method of selecting CRT alone, your accuracy would skyrocket, because in this one you are waiting for a confirmation before you could trade it. Now moving on, Let's discuss some examples of conformational CRT or candle ranges. So right here we've got this two price action scenario, and with them we're going to discuss the significance of conformational CRT and how it could have helped you avoid losses and how you would have been right about selecting the correct CRT. First of all, let's discuss the upper region of the price action right here. So there we've got this price action, and you can see that we've got these equal lows, and what price did is price came down below and took out these lows and rejected below the lows with this candle right here. Now, based on the teachings that I showed you so far about where to find CRT, then you would know that this place right here is a good place for finding high probability CRT, right? Now, you are not sure whether you want to trade this, you want to treat this candle as a CRT or not, or whether you want to use the CRT to frame a trading idea or not, right? You are a bit skeptic, or maybe you are a beginner or intermediate student. So, in that case, you just like I told you earlier, you're gonna wait for a confirmation in the form of the second candle close, and then based off of that you're going to decide whether you want to trade it or not, or you want to generate a narrative with it or not, or determine drawn liquidity with it or not, right? So right here you can see that you would have waited for the second candle to purge the CRT, and then your next objective would be to wait for the second candle to close, and then based off of that you would decide whether to trade it or not. In this scenario you can see the second candle closed outside the CRT, right? Now this does not necessarily mean that the CRT has now been invalidated, because you can still use it under certain circumstances, but that occurs really rarely, and more often than not in such cases price invalidates the CRT if it closes outside, right? So for all of you, the better alternative decision for you would be to invalidate and disregard the CRT if the second candle closes outside of it. Now I know there would be some CRT you would miss because of this rule, but that's not the point, because if you use this rule, then sure you would miss out on some CRT, but also at the same time it would save you from a lot of invalid and losing CRT. And if you balance and weight the losing and the winning scenarios with each other, then you would see that this rule saves you from a lot more invalid CRT than it makes you misses from valid ones, right? And that's what matters, right? That is essentially a filter for you to select a CRT. If it closes outside of it, then you would invalidate the setup, right? And you would disregard it. Now remember, I'm saying this for the beginner and intermediate students, right? Because for me, I can still trade it, but I would have to be really selective in my approach in that case, right? If a CRT closes outside of it, and I look for specific protocols around it and specific key narratives to back it up. But that's advanced knowledge, right? I teach that in CPI, and for most of you, for now, you are intermediate students, and it would be a lot better for you to just stick to this rule of invalidating your setup in CRT if price closes outside the first ranging candle. And then you can see that more often than not in these sort of cases you would see that price does not respect the CRT, and this rule would have protected you from an invalid CRT, right? That's what happens most of the time in this sort of scenario, and that's how you would have waited for a confirmation before you select a CRT. Now let's discuss the second scenario. In the second scenario, you can see we've got the same framework and price section, and again we would be selecting a CRT through the confirmation CRT approach. And let's see how we would have done that in this case. Now again, you need to remember, in this case I haven't chosen a random candle like most of you, right? Even this candle that I've decided to select as a CRT is significant because it's the candle that rejected and purged below these equal lows, and that's why it's important. It's not just a random candle, right? So right here you would have waited for the second candle to purge and then close, and you can see in this case it closed inside the candle range. So based on that factor, you would consider it a correct CRT, and your objective would be to trade it. Now the closing of this candle confirmed the validation of the CRT, right? Now this alone isn't the only one confirmation, and you would still look for SMT divergences, key levels, key times, and so on. But that's another confirmational aspect on top of it that increases the probability of you catching high quality CRT. And right here you can see that the CRT worked out perfectly, and price completed the CRT accurately and reached the drawn liquidity. If you had used this one confirmational tool, then you would have accurately anticipated the CRT and your drawn liquidity would have been correct, and then you could have traded this CRT with either a kiss of death entry, or if this price action is on the higher time frame, then you would have correctly framed your higher time frame drawn liquidity. Moving on, again we've got another example right here of confirmational CRT, and how you can use the confirmational CRT to your benefit. So again, we've got two scenarios of price action, and we'll see how we could have used or traded it based on the confirmation aspect. So first of all, let's discuss the first one. Again, the framework is that you would wait for the closure of the second candle, and then based off of that, you will decide whether you want to validate or confirm the CRT or not. And right here in this example, you can see price close outside the CRT. So because of it, you wouldn't select this CRT or trade any idea around it because it closed outside, and now you would invalidate it because of that particular rule. And then moving on, you can see price did not respected this candle as a CRT and went lower because it closed outside the range. And down here in the second scenario, you can see price close inside of it after purging the first ranging candle. And in this case, you now have enough confirmation because price close inside of it, which is a good sign, an aspect of confirming or validating a CRT. And because of this confirmational aspect, you would have been saved from the first CRT above here, and you would have correctly anticipated and predicted this second CRT down below. Now moving on to the next slide. Here in this slide, we'll talk about advanced CRT, right? Now this type of CRT, just as the name suggests, should only be used if you are an advanced student that knows how to properly integrate ICT concepts with each other, and then also knows how to integrate those ICT concepts with CRT in a proper logical fashion. This sort of method of selecting CRT does not have any confirmation aspect to it, but instead you would be trading the CRT with the second candle and not the third candle, right? You can still trade the third candle, but your anticipation of selecting and choosing the CRT would start right from the first candle, right before the second candle even starts or closes. This sort of CRT, as I said earlier, requires more advanced knowledge, experience, and intuition. And if you are a beginner intermediate student, then forget about trading this sort of CRT or selecting CRT with this sort of approach. Now remember right here, we're discussing the two different approaches to selecting a CRT, right? We've already discussed the protocols for CRT and where to find the CRT in the topic before this. Here we got this example. You can see in the first one, you are unsure whether to select or anticipate this candle to be a CRT or not. And then to gain conviction or to assess whether this candle can be chosen as a CRT, what you would do is look for all the protocols that I taught you earlier. For example, you're going to see whether this CRT is formed at a key time, whether the CRT is in the direction of the high time frame down liquidity. You're going to see whether we are following the order flow. And let's say in this case, the order flow is bearish, and you can see price is rejected above a high, right? And those are good places for finding CRT. And let's assume the CRT was purged at a key time, and with that purge, price also tested a higher time frame key level. Now combining all of these factors and protocols in confluences, you can see that we've built a pretty strong narrative for backing up this CRT based on our advanced knowledge. And because of it, we would have selected the CRT right here without any confirmation, and we would have traded both the second and the third candle, right? The factors were price rejected above a high, the high time frame drawn liquidity is lower, the order flow is bearish actually, and price tested a high time frame key level, and it all happened at a key time. And these were the factors and protocols that would have led you to accurately selecting this CRT without a confirmation. Again, we've got another example. You're not sure whether this candle can be treated as a CRT or not. So what you would do in that case is look for all the protocols and determine your position to see where we are in the whole range and what are the different protocols indicating the CRT to be a valid one. So right here, let's assume the order flow is bullish and the return liquidity is higher, and let's say we've got a key level right around here. So based off of these factors, we would select this candle as a valid CRT without any confirmation, right? What you can also see is that along with all of those factors, this reaction also occurred at a key time, and price rejected below this low and in bullish order flow, and we tested a higher time frame key level. So we would have traded both the second candle and the third candle after the purge had happened, and our drawn liquidity would have been correct. And we would have also correctly generated a trading idea here, right? And remember, this is just 40% of the advanced CRT knowledge that is needed, but this is basically the idea, right? Also, let's say in this example, let's say you did not had enough advanced knowledge to select a CRT without a confirmation. Then in that case, what you would have done is you would have waited for the closure of the second candle, and once that closes, then you could have traded it. And right here you can see price close inside the second candle, inside the ranging candle after purging it, and that would have been enough confirmation for you to select that CRT and then trade it on the lower time frame. Here is another example of it, right? And with the things that I taught you so far, you can probably reverse engineer this yourself, and you can see how you would have selected or how would you would have traded it. Now let's move on to the next slide, and right here let me give you a simple intraday model that you can use for intraday for trading ICT and CRT. Now this model contains all the main ingredients and aspects needed for a complete modular system, right? So first of all, you're going to start off with the higher time frame, and on the higher time frame, you're going to do one thing. You're going to determine your drawn liquidity and your directional price for the day. And you're going to do that with market profiles, key levels, order flow, and many more concepts. And you're going to make sure that they are integrated properly. Now, determining drawn liquidity is one of the most important part of a strategy or a system, right? And without it, every single system is incomplete and redundant, right? It's also a complicated process in which you need a step-by-step approach, right? About how to integrate these different topics that I discussed, and you must have correct, detailed, and comprehensive knowledge about all of its intricacies and details. Now, explaining this whole thought process or this whole step-by-step process of determining turn liquidity could literally take hours, but I have separate chapter for this in my coaching program. And along with that, I have more than 100 trade breakdowns where I use the exact same process in live markets. So if you want to learn more about it, the details are at the end of the video or in the pinned comment of this video, or you can find them in the description. Now moving on to the next step of this model, the next step is going to be to go down to the 4 hour time frame, and there you have two objectives. You have to first of all build narrative, right, with concepts like open, high, low, close, weekly profiles in power of 3, and you must make sure that you properly integrate these concepts with each other, otherwise you could mess up things, right? And the next objective would be to select a key level in a CRT on the 4 hour. And again, these are also selected through a thorough and detailed step-by-step approach. The next step is to go down to the 15-minute time frame, and there again you have two objectives. First of all, to identify the intraday profiles, meaning you're going to build a time-based narrative, and then based off of that narrative, you're going to frame an entry. And your next objective would be to position yourself and execute a trade with an order block entry aligned with the high time frame drawn liquidity and CRT, right? And this is your whole process for a simple trading system. It has all the important aspects needed. First of all, determining drawn liquidity, then building price-based narrative on the 4 hour, as well as selecting key levels in CRT on the 4 hour, and then building time-based narrative on the 15-minute, and then executing your entry model, right? And then for risk management, you need to be aware of your risk appetite, your win rate, your risk reward ratio, and every aspect of your risk management plan and system, right? You also need to have different risk models for personal accounts and platforms. And then you must be disciplined enough to follow this system consistently with a professional approach, which will require you to do and perform both technical performance reviews, risk management reviews, and psychological reviews, which will pinpoint and identify your mistakes and the issues that you're struggling with, and you can then solve those psychological issues, and which will improve you as a trader and improve your long-term profitability, right? This would be your whole trading system. Now, it sounds simple, but you need the correct integrative knowledge for it to be able to accurately use it or trade it, right? Now, moving on, let's look at some examples of CRT. Let's look at the first example here. So you can see that first of all, we've got this higher time frame key level right here, represented by this gray area. The second important thing about this framework is that right around here, we've got this key time represented by this green area. Now, based on that framework, let me explain this framework of price action to you. So first off, you can see that we've got these equal highs, or simply this ranging profile here just above the key level, and liquidity is clearly being generated here. What happened is that price went above to take out this liquidity and to test the key level, right? Now the thing about this reaction is that first of all, it happened within a key time, which immediately makes it a high quality reaction. The second thing is that price rejected above these highs and purged these highs with this particular candle, and with that it also tested a higher time frame key level, right? Now it didn't test a higher time frame key level, but it closed right below this key level. Now the significance of this candle is that first off, it's formed at a key time. Second, it's formed at around a key level, just below a key level. And third, it took out liquidity and purged these equal highs and rejected above these highs. And based off what I taught you so far, this is a high probability location for CRT to be formed. So based on all of these factors, we would validate this candle as a CRT, and that would be our candle range in this case, right? What you can see is that price purged the CRT, tested the key level at a key time, and after that price reversed and closed inside, and after that we reached the drawn liquidity in the opposing end of the range, right? This is how you properly select and find a CRT, a high probability CRT. And of course, if you select random candles, then they won't work. Like they'll only work if they are backed by a proper logical narrative like this and have all of these protocols behind it. We've got another example right here. You can see on the left we are in a bullish order, bearish order flow, and price is consistently rejecting above highs and breaking below lows, and which clearly suggests a bearish order flow. Now you know high probability CRT are formed at rejection of highs, and if you look at this price section on the right, then you'll see that the best CRT were all formed at the rejection of these highs, and it was the CRT that initiated the top being formed there, and after that price reversed and went lower and continued the bearish order flow. Look at the rejection of highs and then the CRT on the right, and you'll see a pattern there that the CRT are always formed at the rejection of these highs. Moving on, here we got this weekly chart of EU, and again you can see that the CRT are formed at key areas and key levels. The first one you can see is the candle that rejected above this range high and purged liquidity. That's why it had so much significance as a candle, and price validated as a correct CRT. Then the second CRT again you can see is the candle that rejected below the low, and that is also a good location for CRT to be formed. And that was the reason those CRT were considered well a CRT, because they purged liquidity and rejected below a low and rejected above a high. And then the rest of the candles CRT you can see have the same logical framework behind it, right? This is how you find how you find and select a CRT, right? It must have all of these protocols and factors behind it, right? They are not random candles at all. And moving on, look at this bullish order flow right here. Price is consistently rejecting below lows and breaking above highs, which suggests bullish order flow. And right here, you can see that every time this CRT was formed when price rejected below a low. If you see towards the right, then you would see the CRT were all formed at the rejection of these lows, right? This is exactly where you will find high quality CRT, right? They are not at random places at all, but at key locations like this, where the candle has significance and a proper logic behind it. And again, you would have matched it with key levels and key times every time if you wanted to validate a reaction or the CRT. You can also see the two different approaches to selecting CRT, and either you would have waited for a second candle to close, or you could have even traded before it by using the advanced knowledge. Moving on, look at this example yourself, and you can probably reverse engineer yourself why this candle was selected as a CRT and a valid CRT, right? It's pretty obvious by now. Here's another example. You can see this particular candle tested this opening gap right here, and we also had an SMT divergence. One asset took out the CRT and purged the CRT, whereas the other one didn't, and which led to the CRT being validated, and then we reached the 50% of the CRT, and it worked out perfectly. Moving on, look at this price action right here. You can see we started off the price action after we rejected below this low, right? And then we tested this FEG and continued higher, and then price purged above that high and we reversed. And on the right, you can see that the CRT were always formed at key levels and major highs and lows. The first CRT was this candle right here, and price rejected below it. The second one was the CRT formed right at this FEG, which made price continue higher, and the third one being the candle that purchased this high, right? Every one of these CRT had a proper framework behind it. Moving on, right here you can see how you would have traded a CRT at the lower time frame. You can see once it's purged, you wait for an order block entry right here on the lower time frame. You would wait for the candle that purged the CRT to be engulfed and for price to close above it, and then you wait and execute on that candle, and you must make sure that this reaction and purge happens at a key time before you validate it. And then the second way to trade it is through the kiss of that entry right here with the last turtle soup before the round liquidity is reached. And again, this would also happen at a key time, right? You can see it yourself. And moving on, you can reverse engineer this example right here yourself. And this is how you trade a CRT through an order block entry in the form of a confirmation entry. You can see we waited for the candle that purged the CRT to be purged, and once it was purged, price then tested it and went lower, and our entry worked out perfectly. All right, now that we've discussed all of that, let's talk about the most important part of this chapter, right? Which is that learning CRT is fantastic, right? And mastering ICT concept is absolutely vital, but there's one key thing you need to remember and understand. You must have a deep understanding of all of the essential concepts that we've discussed so far, and more importantly, you need to know how to integrate them effectively in your trading, right? We're talking about concepts like market profiles, open high low close concept, quarterly shifts, seasonal tendencies, power of three, dealing ranges, and much more, right? And they are fundamental building blocks of success of a successful trading system and strategy. Now, here is where it gets important, right? Mastering each one of these concepts individually and separately is great, but that alone won't take you to the next level. What will truly elevate your trading is your ability to combine all of these elements seamlessly, right? And you have to know how to apply these concepts together and integrate it together with each other, right? Integrating them into one cohesive framework that works within the context of the market that you are trading, and only then you'll be able to trade these concepts accurately. And this is exactly where most trader fails. They learn bits and pieces, but they never fully connect the dots, right? And if you can master the integration of these tools and techniques, you will find yourself not just reacting to the markets but anticipating its moves with confidence and precision, right? Right here in this slide, let me tell you about CPI, which is my mentorship and coaching program. In this mentorship, you're getting access to over 50 plus chapters, and every one of those chapters will cover every aspect of your trading. And they'll not be just separate chapters on important concepts and theories, but also there will be chapters on how to integrate these concepts with each other in a step by step approach in the most refined and objective way possible. Plus, there will be more than 100 live trade breakdowns where I will explain the real time application of these concepts that you are learning. Because, after all, this isn't just about the theory, but it rather is about understanding how to integrate everything into a logical framework and then to be able to execute it properly in the live markets, right? You'll be taught how to determine the drawn liquidity in a step by step approach. You'll be taught how to build narrative both on the higher time frame and lower time frame with a step by step approach. And then you'll also be taught how to correctly build time based narrative and then frame entries on the lower time frame. We will dive deep into risk management, and I'll show you how to apply the right risk models for different market conditions and different account types. You will learn about the psychology of trading, how to manage emotions, how to stay disciplined under pressure, right? And also, along with that, we will also cover journaling so you can track and improve your performance over time, which will improve your long term profitability, right? We will also discuss how to backtest to refine your strategy. And of course, I will also show you my live execution and show you how you can execute the most effective way possible so that you put everything into action. This coaching program will cover every single aspect of your trading that you can think of. And after going through this program, there won't be any confusions or doubts left. You'll have the confidence and the clarity needed to approach the market with a solid and a structured plan and a structured system. You'll also have a private group chat with me, and I'll also be sharing my personal CRT and ICT system and model with you. And it doesn't matter if you are a beginner, an intermediate, or an advanced student, this is literally for everyone, right? It has a complete curriculum from basics all the way to upper advanced where you're capable of executing accurately in the most objective way possible, right? And you can see the other details yourself. The fee is a one-time fee of $360, and the payment method is crypto only. You'll find the crypto addresses in the description and in the pinned comment of this post. What you have to do is send the one-time payment fee to one of those addresses, and then take a screenshot of it and send your receipt to my DM and Telegram, and you'll be given access to CPI, the mentorship, and the group chat. And right here you can see the details of CPI and what's included in it. It'll contain 7 levels of detailed content about every single aspect of trading, analysis, or execution, right? You can see the 4 levels right here in the content included in it. There are also 3 more advanced level worth of content along with it that is secret for now. It's a complete curriculum and you won't ever need anything else apart from it.